everyone, and welcome to the 2024 Gordon Spellman Fund Mid-Year Report presentation. I'm Elijah, this is Maya, Joey, Noah, and Charlie. We make up the investment management team. What we do for this team is we meet weekly to discuss and report on how this fund is performing. We analyze sector by sector the weights and returns, trying to mirror the weights, the sector weights, and outperform the S&P returns. The outline for our presentation, I'll be going over the overall portfolio return, and the rest of the team will handle the best and worst performers, sector weights and returns, sector revenue analysis, performance attribution, recommendations, and go over the rest of the class presentation. So for the overall portfolio return, fund value as of November 15th, 2024 is $476,200.08. Cash value being $36,701.98. As you can see by the graph on the right, the green S&P 500 outperformed the blue Spellman fund by just over 4%. The S&P 500 with a return rate of 11.34%, the Spellman with a return rate of 7.17% in the last 6 months. The beta for the Spellman fund was 0.93, which means it is slightly less risky, less volatile than the S&P 500. But when the S&P 500 grows, like you see in the graph, the Spellman will grow at a slightly slower rate. Next up, we have Maya to talk about the best and worst performers.
Thank you, Elijah. So we'll start with our best performing stocks of the fund so far this year. We have NVIDIA, who had about a 50% return and a 1.45% contribution return. And not only were they the top performing stock in our Spellman fund, but they have also consistently been one of the top performing stocks in the S&P 500 so far this year. And this is mainly due to their leadership in artificial intelligence. Their AI chips and graphic processing units have been in very high demand. Next, we have PayPal with about a 34% return, but only a 0.14% contribution to return. PayPal's success has been due to the rise of e-commerce, including the rise of online shopping and electronic payments. Additionally, they are adding new things to their mobile app, including a buy now, pay later option. And finally, we have Netflix, also with about a 34% return and a 1.46% contribution to return. Netflix has been gaining many new global subscribers, and they just came out with a new ad-supported subscription plan. Additionally, they are still cracking down on their password sharing, so that is causing households to have to purchase more than one subscription plan. Next, we have our 3 worst performing stocks of the fund. To start, we have Applied Materials, who is our worst performing stock so far this year, with about a negative 22% return and a negative 1.43% contribution to return. This is due to a decrease in their orders for their semiconductor manufacturing. And then also they are currently undergoing an investigation due to possible illegal sales of their equipment to China. Next, we have Intel with about a negative 21% return and a negative 0.34% contribution to return. Intel has been struggling to keep up in the growing artificial intelligence market, which is significantly impacting their sales. And then finally, we have Boeing with about a negative 20% return, but only a negative 0.1% contribution to return. Last month ended a 7-week-long production pause due to a labor strike within the company, and that was significantly delaying their aircraft and manufacturing services. So next we have Joey, who's going to be talking about our sector weights and returns.
Thank you, Matt. So looking at our sector weights, all of our weights fall within our Spellman Fund guidelines, as they're all within 5% of the S&P 500. The only sector that is slightly below average is our energy sector, which is about 3% less than the S&P 500. But overall, all of our sector weights fall within our guidelines, so they are not of any concern. Looking at our sector revenue analysis, this is something new that we have done this year. This table is breaking down each stock by revenue, allowing us to see where their income is actually being generated from. In comparison to the standard sector weights shown in FactSet, which give a general sector distribution, this is focusing on specific revenue sources for each company. The benefit of this is that it provides us with the most accurate exposure of our sectors, allowing us to see where our revenue sources are actually moving to our sectors. So this table has highlighted our key differences in our sector revenue weight compared to the standard weight shown in FactSet, but a further breakdown with all the sectors is shown in the mid-year report. So this is an example of Walt Disney's revenue breakdown. So as you can see, about 76% is going to consumer services, 3% to consumer cyclicals, and 20% to technology. So this sector revenue breakdown is taking these revenue sources directly to these sectors instead of consumer services as an entire sector account. So looking at our sector returns, consumer discretionary was our strongest performing sector, which was driven by all three stocks within the sector, all being within our top 10 stocks for the Spellman Fund. Healthcare also had a strong return, which was directly driven to United Health's strong contribution return of 0.99%. Additionally, this was the S&P 500's worst performing sector, having a negative percent. Looking at our worst performing sectors, information technology had strong performances from NVIDIA and Apple, but poor performances from the rest of the stocks in this sector, specifically Applied Materials and Qualcomm. Additionally, this was the S&P 500's third strongest performing sector. Lastly, looking at the real estate, utilities, and materials sectors, all three of these sectors only have one stock in this sector, so this sector's performance is purely dependent on this stock's performance. As you can see, these stocks did not perform as well as the S&P 500, which is why their averages are significantly less than the S&P 500's return. Next, Noah will be talking about performance attribution.
Thank you, Joey. So moving on to the selection effect, here the clear outlier is information technology. So we had a very poor selection of information technology stocks, which actually led to a 14% return lower than the S&P 500. And then next we have industrials. We also had a poor selection of stocks there where our return was lower. However, if you look at those top two, healthcare and consumer discretionary, we had a good selection of stocks for those two sectors, and we had a better performance than the S&P 500. And moving on to the allocation effect, key sectors to look at here are energy, consumer discretionary, and materials. So for energy, we actually had a lower weight than the S&P 500 while still being able to achieve a similar return. And then for consumer discretionary, we could have actually weighted that sector a little bit higher to get a better return, given that consumer discretionary was an outperforming sector for the last 6 months. And then for materials, our weight was a little bit too high, especially since we only have one stock in materials. And then materials was also an underperforming sector for the last 6 months. And then finally, total effect, once again, you see that big outlier, information technology. I believe we really more of a problem with selection than allocation. And one way we can solve this is by diversification, which Charlie will talk about next.
Thanks, Noah. Moving forward, we recommend increasing diversification, particularly in sectors holding just one stock. For example, we observed that these 4 sectors all contain just one stock. And as Joey previously mentioned, 3 of them underperformed the S&P. Those 3 were real estate, utilities, and materials. By adding more stock, we could reduce unsystematic risk and therefore build a more defensive and diverse portfolio. One way we could start doing this is by having future students of this class research these sectors in hopes of finding stocks that are good to put in and into each sector to create that diversification. And actually, some of the upcoming presentations will explore this idea further. For example, ExxonMobil and Coca-Cola are recommending a hold in order to maintain that diversification, whereas Occidental Petroleum is recommending a buy, which would help further increase diversification in the energy sector. All in all, these strategies help illustrate different ways we could create diversification in the fund. And we want to thank you for your time and leave it up to the board for any questions and comments.
Nice job.
Can you go back to slide 7 real quick on Disney?
Yeah.
So where do we get this information? How do we do this? Is this a software or?
This is just on FactSet. So this is RBICS revenue breakdown. Just showing their revenue streams pretty much. It goes like very into detail at the end, but we really only use those like top 3 sectors.
And did you do this for all of them?
Yeah, so we did. Originally, we broke it all down like each stock, and then we have that big chart there. I don't know if you have the report on hand or something, got an email. But that has all the sectors on the report. And then for next semester, we kind of want to plan to do this for the S&P 500. I'm not 100% sure how, because So that's obviously a lot more companies, but we're gonna try and do like a comparison between those two.
The overall point of it's kind of just to see where their revenue streams are coming from and accurately weighting that to that sector that it's coming from. So like right now, if you just go into FactSet under GICS, Disney would go completely under consumer services. But with this weight being diversified to each, it'll like align their revenue stream to this sector weight. So it gives us a more detailed sector weight average on all of our sectors.
So I guess in this example, how would you weight that? Can you go? I apologize if you made that point. So how would you?
So for like business services, it's at 0 right now.
Yeah.
Cause we have no stock that's just like business services.
Yeah.
So then that 0.25 is allocated from, I don't know, some company's revenue.
Okay.
So it's kind of like we're exposed to that sector without having a company directly.
As you can, there's not very crazy differences, like the highest only being 0.77%, and a bunch of the other sectors are even smaller than this, that's why we didn't put them on the table. But Dr. Cyrus wants us to explore this more in the upcoming semester, just to give a more accurate representation on our sector weights.
Practical perspective, I can see where this would come in handy. So I used to manage a fund, and a lot of times we would, much like you have the 5% bands around the sectors, sometimes within technology, we couldn't find enough stocks that were pure technology, but we found one that works more like an industrial stock. So sometimes we would buy that knowing that we're getting the industrial exposure.
Yeah.
So you can kind of play games there,
Yeah.
and it's all based on classification. You know, it might not necessarily be what the stock is. Gotta be, I don't know how you guys would do the S&P 500. You might want to just reach out to FactSet and see if they have.
Yeah, I know. I don't know how we could possibly do that, but
One at a time.
That's what we were saying.
That's what we did.
Well, yeah, so
We
this
did one at a
originally, we
time.
originally did it one at a time, but then we were able to find a way that did it for us. But I don't know if we're gonna be able to do it.
I would reach out to FactSet.
Yeah, that's gonna be a project
Whoever
for next.
whoever
week
you-
for us to look into.
Talk to the good doctor and ask who the sales support person is from FactSet. They might have that for the S&P.
make us buy stuff on FactSet?
You guys got plenty of money. I looked into the black box. Yeah, that might save you a lot of work. Work smarter, not harder.
7,000 cash.
Good.
You good?
Yeah, go ahead.
I'm curious about, at the very beginning, you mentioned you got a 93 beta on the fund. Are you targeting a 93 beta, or are you accidentally into a 93 beta based on market movements? When I heard you say you're trying to outperform the S&P, and then we say we have a 93 beta. To me, I'm asking you, is that a market call? Are you telling me you have a position on where you think the market is going? So to outperform, you lower the beta, or do I have cardinal or mixed?
no, I think our target is 1. We didn't do Sharpe ratio and alpha. I want to do that for next semester, like that'd be good numbers to have. But just for now, we just have beta. And I think we want it to be around 1 and then still outperform, and then obviously Sharpe ratio and beta would kind of, or alpha would.
So if you're sitting on a 1%, a 1 beta, how would you gonna outperform?
That's one.
Use the trainer ratio.
I think there's a way to do it. I'm curious if you
There's
won't tell
beta
me
in
what
the
it is.
denominator, so we would want.
One way would be trading more often than just one time a year. I think, we do this every semester, and that would put our beta a little bit lower versus if we did it maybe every quarter, something like that.
I think that's also because we like cut some things down a little bit. We trimmed some sectors and then bought and sold. We didn't really like adjust for what our beta was.
I can't remember what it was last.
Last year,
I think
or last-
I think it was one last
yeah,
semester.
so we went
but-
down.
So when we made these buy and sells last semester, the beta ended up going down.
I'm not trying to trap you with a question.
Yeah, no,
It's legitimate,
Yeah.
because I noticed the difference, and
Yeah.
when I saw that, my first thought was that you're taking a stance and making an opinion.
Yeah.
And in other schools, I've heard that opinions stated. I was curious if you're.
No, it's kind of just like it's up there.
Yeah.
Now something that we should probably
Look out, like, yeah.
All these returns that you use for calculation include dividends, or is it just?
Yeah, this is total return, so this is with dividends. It's not any interest on cash though, so it's all just equity returns.
The beta is X cash.
beta was, yeah, just for equity.
Just the equities, okay, because obviously if you got a like 9% cash balance, that's gonna take your.
Yeah, no, that's just equities.
So overall, I thought the presentation was great, hit on many points and sounded like you understood what you were communicating as well. So good job on that. One suggestion or one thing that I think would be interested, because we run a relatively concentrated portfolio, you mentioned the sector weights, nothing deviates. But I'd be curious to know if any individual stock deviates significantly. One that stands out is United Health is almost 7% of the fund. Maybe our healthcare sector as a whole is in line with the sector weights. But if that stock itself is much greater than what it's weighted in the S&P 500, that may be something to consider as well. So
Definitely.
it's a good point.
It is.
Alright,
We can look into that next one.
Yeah, I think we're
Let's,
out of time.
are you guys going to the dinner thing? Yeah. Alright,
I'll see you there.
come pin me down and let's talk about diversification.
All right, hello, everyone. We decided to research Trane Technology. I am Will Meyer.
I'm Beyond Kochar.
I'm Teddy Hooper.
Nyla Johnson. I'm Melissa Hellring.
All right, so for our presentation, we'll give you a quick little outline here, and Trane is not in the Spellman fund, nor is any stock like it. From our research, we decided that we want to buy Trane at $350. And that'll be 29 shares, about making up 2% of the Spellman fund. We'll give you an overview, business overview, break down the revenue, talk about their risks, financials, the key two growth drivers which we found, which are AI data centers and sustainability. We'll talk about the valuation and the numbers, the portfolio fit recommendation, and we'll give you a summary.
Okay, so Trane Technologies is an HVAC company, HVAC being heating, ventilation, and air conditioning. They're actually founded in La Crosse about 100 years ago. They operate under two main brands, Thermo King and Trane. Thermo King is the part of the company where they install HVAC systems into transportation vehicles such as trains and buses, and then Trane being the part of the company that installs HVAC systems into commercial and residential buildings. They have high reliance on the United States for revenues. Only about 22% comes from foreign companies, and 70% of the revenues are from equipment. Well, 30% of the revenues are from parts and services. Parts and services would be over time. You have systems for a long time, so you need to replace parts and have routine maintenance. So a big chunk of their revenue is from that. And then we see them as a strong industry leader because they currently have 22% market majority in commercial HVAC. They're really good at cooling large areas efficiently, and they seem to have a technological advantage in their competitors. Trane has a lot of patents, and one of their products, like a chiller, for example, produces ice during non-peak energy hours, which is cheaper and more efficient, and then it uses that ice to cool buildings during peak hours. So we picked Trane because it's an older company. It was in a mature stage, but recently with sustainability and like AI data centers popping up so much, they've kind of become a growth company. So we're looking at right now a limit buy at about $350.
Okay, so right, as you already heard, the limit buy of $350 is 75 at 29 shares. 2% would be about the Spellman fund. We got that from doing our valuation numbers, and we found the target price, which is $385, and then we took the industry average of 10% to find the price that we want to buy at, which is $350. So then going over the business, some of the challenges are environmental regulations and supply chain disruptions, which will slow them down, causing them to lose some revenue. But they have some opportunities through the government and through focusing on smart buildings, and they could get government contracts and stuff like that. So our key drivers for their growth are building AI data centers and their goal to focus on sustainability. But some major risks are the supply chain, global economic uncertainty, trade tensions with tariffs, and geopolitical risks also. So here we're looking at Trane's stock price. We see that they have a 52-week range of $215 to $421, which was about 3 weeks ago. Their expected dividend, which is December 6th, which is $3.36, and that's about 0.82%. Highest price was $420, and their quarterly earnings growth is 23.3%.
On the bottom here, you see the stock price. You see that it's going up ever since around 2022. And when you look at the ROE and EPS, we project that going positive as well, moving up. So, and then just to break down the revenue a little more, you already heard 70% is through their equipment and 30% is parts and services. 78% is in the US and 22% is the rest of the world. You can see by these graphs on the right, it kind of breaks it down by region. And then our 5-year growth rate on average was 7.6%.
Okay, so since there was so much in the US, we decided to break down the revenue further. So this dark gray is American equipment and the light gray is American services. Purple is outside of America. So we can kind of see how the revenue is broken down from year to year. And they've had a pretty consistent like overall upward trend. And then to further break down the revenue, this was the growth rate by each segment. So we have American equipment in the dark gray again, American services light gray. Outside of America is the dark purple, and the total revenue is the light purple. So you can kind of see that there was a significant dip kind of during COVID with negative growth rates, and then it kind of jumped back up, and they're kind of ranging between 8 and 15% overall.
And then touching on our ESG, this is something that Trane excels quite well in. They rank above average compared to all their competitors. They're in the 75th percentile. They have a super strong track record. This is reflected in their reporting as well as their governance being very transparent. One of the few cons that we could find was just that Trane had a limited impact on outside HVAC sectors for ESG. However, their recent partnership with Autodesk, who's a world tech leader, this is going to help promote those innovative, sustainable smart buildings and put that into our system a little more. And then Trane also has donated over 18 million to charitable causes and declaring a goal of cutting their embodied carbon production by 40% in 2030. And overall, because of all of these things and more that you'll hear about our company later, we rank this very favorably. Okay, so looking at some of the risks, we think the first one worth mentioning is probably seasonal products. HVAC definitely can fluctuate based on the time of year since it's heating and cooling. So depending upon if you need like a replacement, like you might not know your heater needs to be replaced until you try to use it. So they kind of may have fluctuating revenue based on that. And then also looking at inflation could definitely be a high probability since inflation tends to be kind of cyclical and it will end up happening. And then the biggest one we want to draw your attention to is the reliance on the American market. That definitely could be a big risk since they have a lot of their parts and like manufacturing in the US and a lot of their like services are in the US. So if something were to happen in the US, that would probably impact their company significantly. And then looking at their financials, the first thing we thought was important to mention is the high PE ratio. If you look at the trailing 12 months, it's about 37.5. And when you compare it to their top 2 competitors and the industry average, it's only all about in the 20s. So significantly higher. That could be due to their high recent earnings. And then also their ROE and ROA are similar, above the industry average and their competitors. Something probably to note is the debt to equity ratio. It has been decreasing, so they've been relying less on debt. And they rely significantly less compared to their top competitors. And then some more information about their debt. They currently have about $5.3 billion in total debt. And then there's about $1 billion in short term, 4.3 in long term. And they recently issued about $500 million in debt over in June. And then they have about $1 billion coming to term within the next 12 months. And then this is just showing when all of their debt is due.
So going forward, our first growth driver would be AI data center cooling systems. This is a very growing industry. There has been an increased demand for energy efficient cooling systems in AI data centers due to the rapid growth and construction of the data centers. Trane's expertise in HVAC and energy efficient solutions aligns well with this expanding market, and we think it would be a very good fit for this industry. So the AI data center cooling market growth rate is projected to be at 29.25% CAGR through 2030. And using this growth rate, we projected a revenue of $1.3 billion annually by 2028 just from this segment. This would add $7.43 to their EPS by 2028, assuming the current net profit margins. Obviously, they can fluctuate as well. And then taking a low growth scenario, we would assume that the market grows slower at 18%. This would impact the revenue and would only bring in about $900 million from the AI cooling systems by 2028, which would reduce the EPS impact and would add about $4.36. On the other hand, if we look at a high growth scenario, we would assume that the market would grow at a 40.5% CAGR. And then that would bring in about $1.8 billion in revenue annually by 2028 and add $11.99 to the EPS. The second growth driver we're going to be looking at is sustainability. Trane's already big on sustainability and creating energy efficient solutions and reducing emissions with their products. The demand for these energy efficient and eco-friendly HVAC systems in green buildings has been increasing rapidly. There's been a global push for it. Some of the assumptions we're going to be looking at is the green building market growth projected at 9.74% CAGR, which would be reaching about $500 billion by 2030 in market cap. This would bring in about $718 million annually by 2028 from green HVAC solutions. And then the total market size for green building technologies is estimated at $500 billion by 2030, which would add about $4.12 to the EPS by 2028 for Trane just from this segment. So looking at a low growth scenario for this, the market would grow at an 8.91% CAGR due to slow growth, which would bring in about $698 million annually just from this segment by 2028. And it would only increase the EPS by about $3.38 versus on the other hand, if you look at a high growth opportunity, we would assume that the market would grow faster at 10.57% CAGR, which would bring in about $742 million annually by 2030 from this, and it would add $4.91 to the EPS. I know this seems pretty close. The high growth and low growth scenario seems pretty close, but the reason for that is that we are optimistic about this, and Trane is already big on sustainability. In the last quarter, they showed an 11% increase in revenue just from their organic growth.
I mean, this is like continuing looking at our EPS projections. We made like we just kind of charted to see the kind of like how there's differences, like the baseline, low growth and high growth, just to kind of give a little bit more of a visual on it.
So for our baseline EPS projections, like Dion said, we had a 29% baseline EPS growth for AI data centers and 9.24 for sustainability. So we're looking at a really large EPS contribution from AI data centers, and we see a total EPS by 2028 of around 20. I'll go back. Okay, go back, go down. You go down one.
Yeah, no, it's that one. This is
Where's go back. There, you just missed it. Go back right there. Sorry. For optimistic EPS, for AI data centers and sustainability, we use 40.5 and 11%, and you can see the growth rates for pessimistic as well. And then something else we noted for our optimistic and pessimistic EPS projections is for our baseline, we use a 12.5% profit margin, which is the current margin that they're operating at right now. Both optimistic, we increase the profit margin by 0.5% each year. And this could be, if they have more output, there'd be less fixed costs per unit. And then we did kind of like vice versa, the same thing for our pessimistic EPS projection. We decreased the net profit margin by about 0.5% per year.
And then this just kind of looks at a good summary of our total valuation projections. Specifically, I'll focus on our weights. So we put 80% towards our PE and 20% towards our DCF. As of close yesterday, Trane's price was sitting right around 416. So that's in between our baseline and optimistic target prices. So we're hoping to have that drop a little bit, but obviously they're still sitting in a good position right now.
Okay, so looking at how Trane will fit into the portfolio, the current correlation is about a 0.67% per. And there's 13 stocks that are above 0.5 correlated, 21 are less. And then, so the fund already has about 10.5% in the industrial sector, which Trane is in, and the S&P 500 only has about 7.5. So obviously that could potentially be a concern if you wanted to purchase Trane. So we would suggest trimming down maybe some of the other industrial stocks in the fund to make room for Trane.
To add on to that, one of the industrial stocks is the Unicorn Group, and it has only given an 8% return in the last 10 years, and it holds about a 5% weight in the Spellman fund. I think that is a stock that could be analyzed next semester to maybe reduce the weight of that in the Spellman fund or maybe sell it off.
And then just to reiterate our main points, so we are recommending a limit buy of Trane at 350. We are saying that this can range from 340 around 360 because it's not a hard number. That's obviously up to you guys to also make judgments on that as well. But the stock is overvalued because of its intrinsic price, so that's why we're still at a hold currently. But it would definitely help diversify the portfolio, and their revenue streams reflect that reasoning, and their industry reliability and constant expansion and new partnerships that they've been promoting definitely will help their industry as well.
Open up for questions.
I can start. So HVAC, it's, primarily what they do. Who are their main competitors?
So Johnson Controls, Honeywell,
Lennox as well.
Lennox was another one. So specifically just for like ESG and their type stuff, they've been significantly better than their competitors as well.
So do their competitors offer the same product potentially, or are they just related industry, not necessarily offering the same product?
I know Honeywell and I think Lennox, they perform better in like the residential market, but Trane, they are a lot better at the commercial market with larger spaces. So that's why they've been getting a lot of market share in like large data centers. And I know also Trane like in large freezers like Trane, they are good at freezing like large spaces. So
Okay, so they kind of have a niche in a few areas.
yeah.
And then just a quick follow-up, the sustainability concept, is that a completely different like business line for them? Meaning they make different products to meet those opportunities, or do all their products have sustainability objectives to them and they're just a growth opportunity because more and more customers are looking for that energy efficient component?
I think the growth opportunity is that they are like more efficient than their competitors. So with like new green building standards, they're usually like the go-to for like contractors that are building. So with the way we did our growth driver for that one is we took a percentage of new like LED growth, LED sustainable building, and then we took a certain market share of that. So we see that as as like the growth driver.
So their standard product meets those?
Yeah.
Okay.
Yep, so all the products they sell today and they offer today are considered sustainable. They definitely haven't done that in the past, but in the last few years, all the products that they've been offering are considered sustainable and they emit less.
Okay, thank you.
So are you just greenwashing the name of basically their main product line?
Well,
I was curious too, because you talk about green, eco-friendly, and I'm like, well, what about the non-eco-friendly?
I know me and Vihan, we actually interned there last summer, and so the CEO Dave Regnery, I think that's how you pronounce it, they totally like took the image of Trane and said it is an HVAC company, but they said ultimately we're like a climate solution company. So I guess it is kind of like greenwash, but.
Well, and let me recycle that question, because or I guess comment, because I did wrong. Can you throw up the slide that has the revenue breakdown where you took the groups? I guess my question, you have it broken out by revenue, so you want to keep coming this way, Yep, right there. So the sustainability piece, is that, if you took off that sustainability, would that just be their HVAC? Is that?
Not
Not
technically.
technically? Okay, because I'm trying to
Yeah,
see what the
so-
different,
How we calculated it is we started with like total commercial construction in the US as like our baseline number. And then we looked to see what percentage of that was like green buildings. So we found, I think that like, I think it was 24 or 25%, 24% were green buildings. So then just for our assumption, we assumed that Trane would match that, which maybe isn't necessarily.
I'm just trying to get a sense as what is that, what's
Yes.
actually in each one of those three buckets? That's what I'm trying to,
Yeah, so
that's
this
a
would
better
be-
question.
About like 24% of their revenue, what we would say is like green buildings, and then we'd say 24 or 25% is AI data centers, and then we said that like 50% is from something else.
So like the Thermo King,
Yeah.
I'm just trying to get a sense.
Yeah,
of
they do
a
this.
lot of
You're putting
green
growth drivers
buildings.
on stuff, but I'm not quite sure what exactly that is.
Yes, yep, no,
Okay, so sustainability is
Those
more
aren't
like,
revenue streams, those are just
yes,
we get it,
things that would drive total company growth is what they're saying.
well, they are.
I think that we have the
But
chart,
we
they have
haven't-
charts in our appendix too.
yeah,
with
we
the
can go
revenues.
into the
I
appendix.
guess I'm just trying to get a sense as to
Same
what,
product.
what's, yeah, I know, that's why I'm confused as to what
So,
That,
is going in where. Like, I think I get the AI thing, because it's like, okay, you're building an
Yes.
AI database or
yeah, I
you
think,
know.
And we had a better time finding actual numbers from that versus like the sustainability.
yeah,
That was more of us like researching the industry averages, and
Yeah.
because Trane does perform so well
Yeah.
compared to the industry, we just kind of used similar numbers.
Yeah.
So
So I'm just thinking like commercial, okay, so is a commercial, like, commercial lines go in one, or, you know.
Yeah.
I'm just trying to get a sense as to what's in each bucket that you guys get. That's fine. And I guess in a follow on. So you talked about like the various, how did you guys come up with your various growth projections? For like the various lines when you were walking through the, cause you had like 29% for your pessimistic and.
oh. Easier if we show the appendix.
Yeah, wherever you wanna show.
Cause I think, so
just kinda
this
curious.
would be kind of like more up, like, this would probably be more clear.
Yeah.
So we said, we started with like, say like. Total revenue, so total revenue would be, well, it's not here, but. Like, say the total revenue was like $19 billion.
Yep.
And we found that, I think it was 24% of total commercial revenue, or like total commercial construction. In the United States total, not Trane, was like 24% was AI data centers. So that's what we said. And then we assumed that Trane has the same market share. Like, we would say that Trane also has 24% in the AI data centers. So we took their total revenue and multiplied it by 24% to get our baseline. So that would be like the 4,652 or 53 million. And then we found growth rates on AI data center construction. So we found a low number to be 18% for like annual revenue, then high growth to be 40, and we averaged them to get our baseline. And that's how we calculated our baseline revenue.
So the growth rate is
Yes.
basically for the whole industry,
Yeah.
and that's just from
So you put it
reliable
from industry
sources.
lab.
Yeah.
Yep.
Just again, because I don't know if you mentioned that when you were walking through. If you actually, where you came up with your growth rates, I'm just kind of curious.
No, I don't know.
Stop there, you guys.
Could you quickly go back to slide 12? Because it's something confused me, but I think I figured it out. Your ROA.
Like,
2023 ROA for Trane.
oh, that's definitely a typo.
Okay.
That should be
It was supposed to be
10
10,
points
that's
something.
what
When I saw it, I had all kinds of questions, but I think.
Yeah, that's definitely,
Okay.
1%.
yeah,
it's not bad.
yeah.
If they're trailing 10 months, they're trailing 10 months,
Yeah.
1.7 is higher.
Yeah, no, definitely.
So what's your growth rate in this? So for the earnings per share growth for Trane, what do you show that as past and future? So in your projections, and so let's stay right in here.
Yeah.
So to get a PEG ratio of 4.68 off of a PE ratio of 37.48, what does that tell me? Tell me what your growth rate was.
I don't know what. Did we use like the overall company one?
Well,
Was that
we
like-
just basically got that from their annual report, the trailing 12 months, PEG.
Yeah, because I think we got this one off the annual report, the past growth, and then we calculated.
So
future
it was
growth.
from the most recent earnings call that they had.
Yeah.
And basically used that annual report that they had in there. And
So their growth rate, was it last year's growth rate, last 5 years growth rate? What do we use as our past growth rate?
We averaged the last 5 years.
Yeah.
And that was 8%.
uh,
If I take 37.48 divided by 4.68, without using a calculator at all, we get about 8.00. So is 8% our past growth and our future growth, or did you have a different? You had a different growth rate going forward, right?
Yes.
And that's an acceleration because of
the two drivers.
From their
Yep.
growth drivers.
okay, great. Now, they're 37.5. I can buy Carrier at about half, Johnson Controls at 2/3, industry average, so they're traded at a significant premium. Why would we pay a premium for this versus one of the other companies?
They do have way better product, so one of our good growth drivers was sustainability. The product they have, and like Teddy said, they also have a bunch of patents for these products. They are the only ones who offer sustainable products which also use less energy. So which is why they have been growing so rapidly in the past year or so.
So are they growing faster than those other?
Yep.
Yeah, when we started this, the beginning of the semester, the price was 340. And now it's all the way up to 400, around 420, it hit 420, 416, I think right now. So
If I'm looking at this and I just look at just the PE ratio, first of all, the PEG seems awfully high. Just personally, if I'm looking at a price to earnings divided by the growth rate, you get into the fours and it seems a little excessive. I pulled it up here and I actually saw it as more like 28% growth over the last year, 17% over the last 5 years. So all of a sudden 37 doesn't seem too bad relative to those numbers. And you're right, Johnson Controls, I think, was growing at more like 13. Carrier was relatively flat. Lennox was like 14%. So if you're at 28% or 17% over the last 5 years, you could justify that higher PE. So that's how I would have thought through that slide. And I'd have been wrong because I always am.
Other questions, or not, Casey's ready to announce?
But the only other thing, you were talking about the risk of the concentration risk here in the Americas. Given the political environment, given some of the issues globally, is that really a bad thing to be concentrated here?
Not currently, I
We
don't
just,
think.
we thought it could just be like, if something were to happen, it'd probably have like a really big swing, so we're like, it's probably worth mentioning, but. And there could probably be good outlook.
It also depends what you're looking at. As for the imports they get for their parts, most of them, I would say about 49%, 50% are in the United States. But they also get the majority from China, and then the third is India. So they get 1550 shipments every year. Well, which is in the United States, but they get 1520 shipments from China, which is around the same number. And then they get 528 shipments from India. So if these tariffs do come into place, that could be a potential risk. But again, if we look at a different side of it, where we do have most of the American market and then most of the services here as well, I think that is a good thing for us versus the other companies.
Go to your valuation slide, please. Just a couple quick questions. How did you guys, and maybe again, I missed this, apologize, because I was writing down a bunch of stuff. Let's just talk about your target price and your philosophy around, you know, when you have the free cash flow. Yeah, right there. Okay, so baseline's 385. You guys want to put in a buy limit at 350. Just looking at the free cash, and you guys did a 80-20. What was the philosophy around that weighting decision? Your 80% PE to 20% DCF to get your various target prices.
Well, we weighted PE more because we think it better reflected our stock's price. We think it is like a little overpriced, but a lot of the market is also overpriced, especially like stocks revenues or Trane's revenues are expected to increase more than 10-15% in the next upcoming years. So we thought the PE ratio was a better reflection of where we can get a limit buy closer to the current price.
So it's basically
Adding on to that PE is also, we did take 80% PE because that's how the market would evaluate it versus the DCF, which is based on the projected growth rates. It is overvalued, which he said most of the companies in the S&P 500 are. So which is why we wanted to take a higher weight for the PE, because that's how the market would evaluate it versus an internal evaluation.
Overvalued relative to what? Isn't the market always perfectly valued based on all the information that we have, and that's where it trades where it does?
I mean, comparing it to the S&P 500.
Because I would actually look at this and say, market seems to agree with your fair cash flow numbers or free cash flow numbers. That is free cash flow to equity. So if I'm an equity investor, I'm buying that company, that's the free cash flow that would be available to me as an investor. And the PE is just whatever the market attitude is that day. Are we feeling greedy? Are we feeling scared?
So you're saying in an overvalued market, you would be more conservative to focus on the free cash flow because that is a little more certainty than the wins market telling you what the valuation should be from a PE perspective.
That makes sense.
All right. Okay. Yeah, there's some good discussion around there, but we don't have enough time. But thank you for that. And then lastly, because I think we got one minute.
Sure. Make it one.
So how did you guys, what was the philosophy around using so you have your baseline at 385 and you guys came up with 350. So can you just walk over that philosophy a little bit more because it's unique. And I applaud you actually for coming up with this kind of format because I don't think we've really seen anything like that in the past. Where there's been an overvalued stock and somebody says we like it for this reasons, but here's we should buy it. So kudos to that. But I'd like to dig into your philosophy very, very quickly. And if not now, we can do it dinner. You'd rather dinner. You know, that's a classic buying time response.
Give us a few hours.
Okay. Okay. Well, okay.
Good afternoon, faculty, staff, members of the board, and other audiences. I'm Emma. This is Andrew, and that's also Andrew and Haley. And together we're analyzing ExxonMobil, a stock currently in the Spellman fund.
So first we will be going through our overview and then our revenue breakdown, few risks, our financials, a couple key growth drivers, our valuation, how we feel we fit into the portfolio, and then a few recommendations. The economy and oil market is in an increasing demand for energy in developing countries, and they're also looking for a transition to cleaner energy. The price for oil is expected to decrease because of the shift in global demand and geopolitical stability. ExxonMobil is one of the largest publicly traded gas and oil companies in the world, and we are currently in the Spellman Fund. A few key aspects include delivering industrial solutions, transforming transportation, materials for modern living and energy supply. We have 4 streams of revenue: petroleum refineries, chemical, plastic, and rubber materials, fossil fuels and natural gas, and petrochemicals. We are recommending a hold in our position, and we are currently in the fund. We hold 1.98% and 85 shares. We are the only energy stock in the Spellman Fund, so we are pretty underrepresented. We have steady income through dividends and a high potential for growth.
So as of market close on Wednesday, the current price was 117, which we used for these calculations here. And including dividends in our calculation, we got an okay target return of about 5.6%, which again is leading us to recommend a hold. Price volatility and environmental concerns are some of the main challenges that Exxon faces, but we also have opportunities to continue to capitalize on our large market share and continue growth. And then oil demand and alternative fuels are the key drivers that we identified and we'll be discussing later.
So Exxon started the year out at a price of about $102, and they also had their current year low in January of about $97. As you can see from the past 3-ish months, the price has been between $110 and $125, and the year-to-date high was in October at about $125. We have seen some increase in our PE ratio from the past 2 years, but we also have seen a decrease in our ROE and our EPS, mostly due to the decreasing oil prices. As stated, our main revenue streams are oil, which make up 80% of the revenue, which is our downstream and midstream revenue, and fossil fuels and natural gas, which is our upstream, make up about 8%. Petrochemicals and alternative fuels is about 4%, and our chemical, plastic, and rubber materials such as like lubricants, plastics for medical devices and technology, and just some film for food storage and stuff, things like that. That makes up about 8% of Exxon's revenue. As you can see from the graph at the right, you had a significant decrease in revenue in 2020, mostly due to COVID-19 and people not going to work anymore, and just general decrease in demand for oil. And then in 2021, things kind of got back to normal as people started going back to work and things started opening up. In 2022, we saw a large spike in our revenue, mostly due to the high average price of oil and good economic conditions. And then in 2023, we saw it go down again as oil prices decreased. Now, here are the breakup of the past revenues by stream. The actual breakup we did ourselves since we could not find it on Exxon's financial statements. So in 2023, Exxon had about $268 billion in oil revenue, and in 2022, they had about $321 billion. And that is taken from like the breakdown of the revenue from FactSet RBICS.
So on the left here, we have some of the positive aspects included in Exxon's ESG reports. And I'd also like to mention that they often contribute to charitable causes like natural disaster relief and education. And then on the negative side, Exxon does have higher greenhouse gas emissions, which presents a little bit of a problem for the company because higher supply and more production is good for business, but it will also lead to higher emissions. And then worker safety and environmental disruption are two other negative ESG factors we identified. So overall, we give Exxon a neutral ESG score, mainly because of the industry that they're in. They're going to continue to be scrutinized for their operations, but they are a crucial energy provider, and we believe that they're taking as many steps as they can to get more sustainable practices and capitalize on cleaner energy.
This is the risk matrix for ExxonMobil, and we narrowed it down to 8 main ones that we thought were riskiest for Exxon, and they are environmental regulations, supply chain disruptions, increasing costs, litigation and legal, shifting consumer values, geopolitical and political, falling prices, and market exclusion. We chose to put environmental regulations as having the most impact just because of the shift to cleaner energy that people are looking for. And we thought that the probability of litigation and legal would happen more often because of how big they are as a company.
For Exxon's financial ratios, we see a general increase in the ratios for the past 2 years. But we also see some decreases in those ratios like the ROE, ROA, and the net profit margin, which could be problematic for Exxon because this means that they are not making as much money. And their net profit margin is particularly a concern for us because it is farther away from the industry average. And with the oil prices expected to decrease in the future, we expect a decreasing net profit margin, and that goes along with rising costs that might happen with oil production. For their competitors, Exxon mostly leads their competitors in their financial ratios, but it's a little hard to compare Exxon to their competitors because the next largest, Chevron, only makes up about 60% of Exxon's revenue, and Oxy is like a drop in Exxon's ocean of revenues.
Exxon believes that their financial strength is a huge competitive advantage, and relating to debt, they've used this financial strength in the past by using internally generated funds to cover the majority of their financial obligations. As of November 1st, our year-to-date debt repayment was $4.7 billion compared to our period-end cash balance of $27 billion. And these numbers are reflected in our low net debt to capital ratio of 5%. As far as their debt structure, short-term debt makes up about 17% of total debt, compared to long-term debt at about 83%. And the long-term debt is mostly made up of senior unsecured debt, about 94%, and then 6% in municipal bonds. In 2023, Exxon had debt issuance costs of $88 million. And then this graphic here shows the long-term debt obligations that will mature in the coming years.
So ExxonMobil's first main growth driver that we identified is the increase in demand for oil. With oil making up 80% of ExxonMobil's revenue, it has the biggest impact. OPEC is forecasting a 9% increase in oil demand over the next 5 years, which is roughly a 1.8% increase each year. And this growth will be derived from different emerging markets and also an increasing population. So we're assuming that this 1.8% annual growth rate in demand will apply to ExxonMobil's oil sales. And we took oil prices based on the futures market. We took the futures for the months ended for each year and took an average of them to determine an average oil price for the next 5 years. And we then took these prices and multiplied it by their expected increase in sales to find out their additional increase in revenue each for the next 5 years. Now, for a pessimistic and optimistic scenarios for these, for the pessimistic, we used oil prices are lower than expected, which could be caused by a higher supply or a lower increase in demand. And for this, we weighted the lower month-end futures higher than the higher prices to bring the price down below what they were for our baseline scenario. And for optimistic, we used higher prices, which could be caused by a lower supply or some geopolitical conflict, which tends to increase oil prices, or a greater than expected increase in demand. And for this, we weighted the higher futures, obviously higher, in order to bring the price up above our baseline scenario. Our second main growth driver for ExxonMobil is alternative fuels. The first being blue hydrogen production, which is a cleaner alternative to natural gas, as they're able to take natural gas and through the refining process, they're able to filter out the carbon dioxide before it enters the atmosphere, making it cleaner. And this is projected to have a 12% annual demand growth rate over the next 5 years. And a second alternative fuel that ExxonMobil uses is biofuels, the main one being algae research. They're able to derive fuel from algae, and this demand is expected to increase 84% by 2030 via ExxonMobil. Now we're assuming that ExxonMobil is able to produce these alternative fuels at their expected capacity, as they are not doing the blue hydrogen yet, and that's a coming project. So we're assuming that that's working at full capacity, although the algae research is something that they're currently doing. So we're assuming that they keep the same market share for alternative fuels as they currently have. And we're assuming that this is also additional revenue and not replacing their natural gas sales. And we use a 12% growth rate over the next 5 years. And these are some of our projections, but our full ones are going to be in the appendix. Now, for a pessimistic scenario for these alternative fuels, we're assuming that their blue hydrogen production only starts out at about 50% capacity and then increases up to full capacity over the next 2 years. And for optimistic, we're assuming that both of these alternative fuels are producing at their full capacity, algae, which they already are doing. So for our valuation, we were able to calculate our EPS. We started with that other EPS is their past EPS with their growth rate continuing on. And then we added in their two main growth drivers to get their total projected EPS for the next 5 years. And now this is a comparison of if the optimistic scenario or the pessimistic scenario both pan out to be more accurate than the baseline. This shows the effect on their next 5 years EPS if either of those were to come true compared to the baseline. And as you can see, the EPS is relatively flat, slightly decreasing over the next 5 years, but that is due to that increase or expected decrease in oil prices. Even in our optimistic scenarios, they're projected to decrease over the next 5 years. So using that, we were able to come up with a baseline combined target price of $119.61. Comparing that to the pessimist and optimistic, I mean, there's a kind of a big variation. But with the current price at $117 and as of Wednesday close, we see that our target price is just above the value, or excuse me, the target price is just above their current price.
Exxon fits in the stock as it is moderately positively correlated at about 0.46 with the fund. They do not have very many high correlations. As you can see, it drops significantly after about 7 or 8. But they do seem to more correlate with stocks in the industrials and the financial industry, and these correlate with those in the technology industry. Exxon is a sensitive stock, so it is sensitive to market changes and rates increases and decreases and just downturn and other market conditions. It is currently the only energy stock in the fund, meaning that if we got rid of it, there would be a deficiency in the energy sector. To summarize, we think that Exxon is a hold because it is a relatively stable and strong company. We do see an expected decrease in oil prices in the future, but an overall expected EPS that is pretty strong. We expect growth to come from the emergence of alternative fuels, which is a alternative market, and future demand growth. We pay dividends quarterly, and we have a target price of about $120 with a current price as of Wednesday of $117. Right now it's at about $114, $115. And our target return is 5.6% with about a $4 dividend. Questions?
We have about 17 minutes for question.
You go to your revenue breakdown slide where you had oil percent, 80% oil, 7.64% fossil fuels. Isn't oil or fossil fuel. And then where's the alternative? Oh, that's the 4.28 is petrochemical. And how much did you have a breakdown alternative versus petrochemicals?
No.
So you talked about alternative energy as a growth driver, 84% growth in the algae business. So what's 84% times 2%?
Small.
So
it is a small part of their revenue, but we're just thinking more while it won't be a factor in the next 5 years, it's more of a long-term thing as there is a growing shift towards wanting cleaner energy. It's more so that they're being prepared for it now versus if there becomes more regulations or incentives to go clean, they'll be ready for it versus having to catch up then at that point.
And I think you already answered this question. We'll see if you give me the same answer when I actually ask. 5.6% target return. I can go buy a 10-year treasury for $4.15. You know this, right? Is ExxonMobil a riskier asset to hold versus a treasury? And is 140 basis points enough of a premium? Or is there another reason we would hold this? And you don't have to answer if somebody else wanted to take it.
I mean, for my answer, I would just say that you can't really get rid of, in a portfolio, you don't want to get rid of an entire sector. And right now being the only energy stock in the fund, it would be worth keeping this over trying to move on to a different one, a smaller company. I mean, they're largest, most stable. They're a pretty stable price company, so we just think it would be a good idea to hold on to this versus just get rid of the energy sector completely.
Good answer. Nobody else has one.
You're on a roll, man.
I'm on a roll. I asked the last group about a PEG question, so I'm gonna ask you too. So on your PEG ratio, I'm assuming the price will be a positive number. The earnings will be a positive number. So PEG at negative 12.7.
Yeah.
See an earnings decline over time?
The earnings decline is basically due to the decrease in oil prices that we're expecting. So we took an average of the growth rates for the next 5 years, and that ended up being a negative 1.1%, which does give us the negative PEG ratio.
So price is down 1.1%?
EPS is going down.
All right, so production was going up 1.8%, but price was going down 2.9%, so you're down 1.1% crudely. Is that where
You really are.
I'm on a roll? I'll let somebody else ask about contango and backwardation.
You wanna click admit, let Spellman in? Okay.
If I could, I'm just having, at a macro level, I'm having a hard time following. We're saying we're highly sensitive to the price of oil. We expect the price of oil to go down, but it's being made up for in the capture of there's more oil to be sold on a global. But why is the price of oil coming down?
That's just what the futures market is predicting. Obviously, oil prices are hard to predict and they're very volatile, but we figured that was the best way that we could predict solid numbers for future prices. We just use the futures market.
To my way of thinking, the reason the price of oil is coming down is they're anticipating less demand for the use of oil.
We were finding that they were having an increase in supply of oil. That was what OPEC is projecting, an increase in supply, and then also an increase in demand. But so they kind of offset each other, but it ended up being a little bit more negative.
Okay, so you're anticipating the use of the product is going to go up at the same time the price is going down more on the supply side than on the demand side.
Correct.
Okay, fair enough.
On the cleaner energy, did you guys look into, and we spent LG, I never heard of that before, but on the carbon capture, I believe they made a pretty substantial acquisition in the carbon capture.
Yeah, they're
market.
building a plant in Texas to begin this, was it 2027 or 2027?
Mm-hmm.
Do you feel like that could be more of a growth driver than this biofuel algae thing?
Right, it would be a bigger growth driver than the algae. They're currently doing the algae and it is a relatively small part of revenue, but they're expecting this to be a lot bigger of an impact.
And have they given any sense of what this carbon capture market could look like in 2 or 3 or 4 years, or they've been pretty?
They have not. On their website, they focused a lot on by 2050, so it's hard to quantify in the next 5 years. But we did find some expected growth rates on their website. But yeah, they were thinking a lot more long term with this plant.
You go to the slide where you talked about the debt. Forget which number it was.
Control.
Click on the slide.
Use
again.
the mouse. Maybe the next one after the get to debt slides. Oh. That one, this one here. So in the long-term debt, can you explain the breakdown, the senior unsecured and the municipal?
I pulled that from their annual report. No, from their the most recent report. That's just they said it's 100% in notes and bonds, and that's the breakdown that they provided.
Okay, so you're saying those are bonds that they've issued? Or those bonds that are maybe on their balance sheet?
Yeah, on their balance sheet.
Okay. So I think that would be a different thing here. It seems like you're talking about debt that they're issued in terms of their debt outstanding. But you're listing municipal bonds, which would be issued from a municipality, so I guess I was a little confused about what that was there. So maybe just a kind of learning point, and make sure, you know, it makes sense in terms of what's on the slide, in terms of what you're trying to talk about. The table where you had your growth drivers, other EPS over the following years. No, I think it was that one. Yeah, this one here. So I think it was mentioned the other is just looking at their historical growth rate for oil or
Right,
all
what their 5 or 10 years before, what that was growing at, we attributed that to their other, and then we factored in the 2 drivers to get their
So the
total.
driver one, which is, you're saying there's going to be an increase in demand, but with lower prices, so it's gonna be a net positive contribution to EPS?
Yes.
But that's how, oh, sorry, for asking multiple questions, how is the other EPS that's slightly declining, right? So is that also including the
That's
same math?
including the new prices, so in that case, it's going down because the so their price was going down, but the growth rate that they were growing at, the lowering prices offset what they were growing at, so that's why it was kind of going down. But for the drivers, we're assuming new additional markets, so that was the positive aspect of that.
Okay, so if the price is going down and the driver is their new growth opportunities.
Yeah, driver one had a
how
higher
is there, how is there gonna be growth in the other? Are you double counting the growth there, I guess is the question.
Core business is going down because they're using the spot price, which is declining. Their barrels aren't keeping up, so that's what their other is. And then, you know, growth drivers, which are.
I think I get that, but I think you also said you're using kind of their baseline growth rate of
Yeah, their
production.
baseline growth rate from the past couple years was very minimal. So that's why it's decreasing, because the lower prices with a very minimal growth rate made a more of a negative shift. But for the driver one, we're using a higher growth rate even with the lower prices, so it offset it more.
Okay, so you are using different growth components.
Correct.
Got it,
Yeah.
okay, thank you.
Yeah. So you can do that.
Yeah, sure. So they do have municipal bonds.
So
They do.
you can, well, because there's taxable, who's a bond guru? You have taxable versus non-taxable muni bonds. So I think what they're doing is they're probably coming in and saying, we're gonna do an energy project for LaCrosse County.
Oh,
and
got
a
it,
taxable muni
okay.
bond. So we're gonna issue that.
That doesn't.
I didn't learn about in my year off about taxable versus untaxable muni bonds. I didn't know there was a difference, so I think
Alright.
that's what that is getting at.
What is the difference? A lot of taxes you pay
The rate.
It'd be the rate, and then the taxable bonds would be from a situation like where it's Exxon versus an actual LaCrosse County project. There's some language around what the project is for and who's actually doing it.
Yeah, so they have this, doesn't give much detail, it just says industrial development revenue bond.
Ask your watch. What's the difference between a taxable and non-taxable?
Okay.
Thanks for the
It
clarification.
is, there's it's an issuance of the municipality.
Correct.
It goes under the municipality's name, but there are only certain projects that become taxable.
Yes.
You know, I think housing, I forget,
there's
there's a
certain-
handful of things that they can issue for and get the tax exemption. The rest fall outside.
You're welcome.
Thanks.
I have a question. How did you find the future or predict future oil price? I think you have a list of numbers there.
Yeah, so for these ones, these were the baseline scenarios we used. These were taken, we took the futures market.
Okay.
And for all the months ended, we took an average of it. And then for these, we, for the pessimistic scenario, we weighted the lower prices futures.
Okay, I have a question. Other than the future contract price, future contract could be wrong, right? And how low could the oil price go? What's the worst case?
That's a good question. I guess we haven't researched past oil prices as much.
Just think of any way to find the lowest oil price.
The lowest oil prices, I mean, at least in my lifetime, probably happened in 2020. But even, I'm not sure what the oil price is, but I know gas was down to what, $1 per gallon?
Yeah, that's the exact time I'm asking. It
It would be
basically,
negative. You could actually, yeah, they would pay you to take it off their hands.
Yeah, we didn't look into that as much as the future.
yeah,
It's also been in the 200s.
Right.
actually, there is a break-even point for the oil company to survive, right? It's below that break-even point, no matter US company or OPEC, we do everything we can to drive the oil price up. The lowest case or the worst case scenario is around $40 per barrel. So it still can happen. There's something else you can think about. It actually happens, you remember correctly, that's the time. And that's not only that point. A couple of times, maybe plus decades. Yeah.
Would you say this is a normal shaped futures curve for oil prices?
I don't know. Because we didn't see a curve, we were, it was months ended, it was a chart with whatever,
Average oil prices per month.
yeah, per month, and then it had it for every month in the year.
So if you plot this,
Yeah, we didn't.
that's your
yeah.
curve. So you've got. So when it's downward sloping, it's in backwardation. The normal shape would be contango. Where it's upward sloping, just the future price. Generally speaking, of a commodity, the expectation is, if the commodity price is going to go up over time, if no other information, you would tend to see a slight upward slope to it. So you're right to assume that lower future prices imply that the market expects lower prices over time. Yeah, so you're paying the lower price for the future rates. The market's wrong. I want to follow up on this. Did you guys look at what point, at what dollar price do they stop making money?
Oh, we did not factor in a break-even point.
I don't remember exactly, I think it was, they paid 60.
So
60.
Do you have their total revenues and net income in dollar terms somewhere here?
Is it in the appendix or just in the?
That revenue, we have to go forward. Okay.
Is it in the appendix or package?
We have revenue in our pie charts. Total revenue, 333. Kind of what you're talking about?
Do we have a net? So this is good. We do, if you had a net income number, you could back that out to kind of come up with your expense. And then divide that by the number of barrels produced. To figure out what their kind of rough cost is per barrel.
Yeah.
I believe that their revenue for net income for 2023 was 36 billion about.
Net total revenue.
67.
Okay, I was just looking at the 31s. Okay. Got it.
Total was 337, 333 million.
Okay.
So 36.
So 297.
We have 1 minute left. I don't know how long your math is gonna take.
Years.
Sorry, could I ask?
So is it in the 50s?
Hello?
Say 90 or 60 when you were doing your calculations. 290 or 260 did you put in?
I took 290. Did you say 36 billion of net income?
Yeah, 36 billion net income. That's total, not for just for the oil.
So I guess I looked at 333, which go by this number. Either way, it's some percentage of that. So you're probably somewhere in the 50s, maybe as a break even.
Sound about right. Oh, the other group found one at about 40 for their company, so I think 60, 50, 60 would make sense.
So you're saying below 60, it doesn't make sense to pull oil out of the ground.
If that's your only, I mean, I'm sure they have other levers they can adjust. Whereas I think Saudi Arabia can pull it out of the ground for 5 or 8 or something like that.
Okay.
All right, so my name's Matt. I'm here with Jack, Alex, Ben, and Andrew, and for our stock review, Coca-Cola.
Click on the slide and then it should be good.
Okay, so I'm gonna provide a brief overview for you all here. So to start, we're gonna be talking about how the fund is already holding the stock. We have 95 shares valued at roughly $5,900. Next, we're gonna go over a few financials that we have, so some key ratios and figures, and then the provenance of the dividend of the company. Next, we'll touch on some key growth drivers, which include our Asian market expansion and health-conscious beverage contributors. We're gonna touch on our valuation numbers, our key risks, which include regulatory risk, failure in new market expansion, and a potential bull market on the horizon. We're gonna go over our overall recommendation, which, just so you all know, is gonna be a hold up front, and then we'll provide a recap at the end. All right, so a bit of an overview on the business model. So the company was established in 1888, went public in 1919, sold in over 200 countries, and it's number 94 on the Fortune 500 list. Some of the key revenue drivers that the company has include finished beverages and our concentrates and syrups as well. And then the current performance of the stock, the market cap is around 268 billion, and the current price is around $62. All right, so our main overview, our view on the stock is that it provides a safe option for investors with a proven history. Our recommendation, as I said before, is going to be a hold today. And some important things to know is that the company has a strong dividend, the largest market cap of its sector, or of its industry rather, and low debt levels as well.
So as Matthew stated, our recommendation for Coca-Cola is a hold. Some of the reasons behind that is that Coca-Cola is the most consumed soda in the world. Coca-Cola also does have the largest market cap for the industry. And Coca-Cola also has a strong dividend of just below 3%. And finally, we think that Coca-Cola is ultimately a low-risk investment. Currently, we have our target price set at just below $63, and currently Coca-Cola is trading at just above $62. Including our dividend, this gives us a total target return of just above 4%. Coca-Cola is also in two main lines of businesses. They sell both finished products and concentrates and syrups. Coca-Cola is the most purchased soft drink in every country that it's sold in, except in Scotland. There were a few key challenges that we found throughout this process, them being competition and brand loyalty. There are a lot of substitutes out there for Coca-Cola, and typically when consumers pick a soda, they tend to stay with that one for a while. Our two main drivers is global expansion, specifically into Asian markets, and health-conscious beverages. There are a few key drivers behind them, two of them being population growth and economic growth, and then also a change in consumer trends. There were a few risks that we identified throughout this process too, some being regulations, supply chain issues, and failures in new market expansion.
All right, then going more into our business overview, we're going to be looking at ESG. So in Coca-Cola, so the pros are the business model innovation has been sustainable since they introduced and own lots of brands. And for supply chain management, they had strong relationships with their stakeholders, good manufacturing, and a faster delivery process, increasing customer satisfaction. Then for material sourcing, they gathered raw materials, which come from natural resources, which it makes their materials more efficient. And for product design and life cycle, they look to have a cleaner environment. Going into energy management, they save energy by reusing plastic. And for greenhouse gas emissions, they decrease plastic pollution. And then another pro is waste and hazardous materials, which has been effective. And then going to our cons for Coca-Cola's ESG, its leadership and government has been a little downside recently. And for competitive behavior, as mentioned, there was some struggles with implementing sustainable strategies that keep up with competitors. Then for business ethics, they face legal and regulatory challenges. And another con is critical incident risk management, which they had a little downside of that also. And the overall ESG rating we give on Coca-Cola is neutral. They have good things they're planning on ESG that's coming in the future, but still has a couple things to fix. And comparing to our key competitors, Pepsi slightly outperforms Coca-Cola, and Dr. Pepper performs at the same level as Coca-Cola. And comparing Coca-Cola to its competitors, we see that they're all consistent, staying at the ESG rating neutral.
Just moving on to some key figures here. First, we're going to take a look at PE ratio. It does remain slightly elevated, hovering around 25. ROE remains consistently around 40% over the past few years. And with EPS, we have seen some ups and downs. This is due to changes in revenue over the years. We see that from $2.26 in 2021, dipping slightly and moving back up to $2.50 in 2023. When breaking down our revenue streams, we wanted to do it by concentrates and finished products. This is just because Coca-Cola has over 40 different product lines. So this is the best way we figured to break it down. Concentrate currently represents about 60% of Coca-Cola's revenue, whereas finished products is around 40%. Over the last 5 years, we've seen growth rate in concentrates at around 6%, and finished products, we've seen around 13% over the last 5 years. Moving on, one thing that's important to touch on is that concentrates tend to be slightly more profitable. So seeing growth in that is always good. And over the past 2 years, it has actually outperformed finished products in growth. From 2022, comparing that to 2021, we've seen 10% growth in our concentrate business and 12% growth in our finished products, which makes for total revenue growth around 11%. And then comparing 2023 to 2022, we've seen concentrate remain at that high growth of 10%, whereas finished products dropped dramatically down to 1.5%. Overall, the revenue growth was around 6.4% over the previous year. One thing that we wanted to highlight with Coca-Cola was its dividend. We've seen 62 years of consecutive dividend growth, currently at $1.92 per share. This is actually a 407% increase over the last 20 years in their dividend, which averages out to around 20% per year. What we've seen over the past few years is Coca-Cola likes to keep a relatively stable dividend payout ratio of around 80%. However, this is dependent on other factors such as revenue. We've seen in down years that they will tend to go over that payout ratio. Lastly, comparing the dividend to competitors, Coca-Cola does tend to outpace them. However, it is only slightly compared to Pepsi. And then it does outpace Keurig Dr. Pepper in dividends by kind of a wide margin.
All right, next we're going to be touching on some important financial figures. A couple things I want to direct your attention to. We'll start with the net profit margin near the bottom. We can see that Coca-Cola has a 23% net profit margin. This is an increase over the industry by 6%, and it's over double Pepsi's net profit margin, which just goes to show that they're quite efficient in turning their revenues into profits. Next thing I'll point your attention to is our PE. We can see that it's slightly inflated compared to the industry average. A lot of this has to do with the fact that it is a very preferential stock for a lot of consumers. People tend to drive the stock up just because they know it's a stable stock.
All right, then going to our debt, its capital structure measures debt and equity and also goes into operating leverage as well. And our typical cost of debt, our interest rates are often between 3% and 6%. And our highest rate of cost of debt on Coca-Cola is found to be 5.4%. And what's maturing in the future in 2026, two debts are reaching maturity, one of 1.88% and one 0.75%. And there's going to be few debts in 2027, 2028 as well. And measuring our total debt by debt class, notes and bonds make up for the most debt of 91.6%, leading to 40,000, 50,000 amount of shares outstanding this quarter. And short-term debt also making up for short-term commercial paper measures 4.7% of debt and term loans 3.7%. And short-term debt and term loans has not had much debt recently, which leads to 0 to 10,000 shares outstanding this quarter.
So the first growth opportunity for Coca-Cola is going to be growth into the Asian markets. This is specifically China, India, and Japan. These three countries combined have roughly a population of 3 billion people, and that this market accounts for 8.3% of Coca-Cola's revenue. When you break down their sales per person in these three countries versus the US, In these three countries, it's $1.86 per person versus the US where it's $52 per person. So if we project some of these numbers onto revenue and earnings per share, the current revenue is $3.8 billion. We predicted a growth rate of 6.5%, which would bring the revenue to $5 billion by 2028. For their earnings per share, we got 23 cents per share, and this accounts for 10% of their earnings per share by 2028, growing to 33 cents. And then for a pessimistic and optimistic look onto the scenario, for our pessimistic, we use slowed capital spending, which lowered the earnings per share for the growth rate. And then the optimistic, the earnings per share growth more. Then for the second growth driver is into the health conscious beverages market, which Coca-Cola is positioned well in with their products such as Body Armor, Powerade, Topo Chico, and also their diet sodas. This accounts for 25% of their total revenue. And this is an expanding market, growing to over $400 billion by 2028. So if you look at those on the revenue and earnings per share, the current revenue for the sector is $11.6 billion. We found a growth rate of 5.87%. And by 2028, the revenue would grow to $14.5 billion. For earnings per share in this line of products, we found 63%, which is 27% of their earnings per share. And by 2028, growing to 79 cents. And then for the pessimistic and optimistic look on these numbers, we use a slow demand for the pessimistic and increase in demand for these health conscious beverages for the optimistic, which would reflect by 2028 about a 5-cent difference in each way.
All right, so next we're going to be looking at our baseline forecasted earnings for the next 5 years. So starting with our driver one, we expect it to start at 23 cents in 2023, expanding to 28 cents by 2028. Driver two is going to start at 63 cents and move towards 75 cents by 2028. The rest of our EPS, which we know Coca-Cola is obviously highly invested in other areas as well, starts at $1.46 and moves towards $2.27. And then our total EPS is going to start at $2.32 and work towards $3.35, incorporating all those factors. Next, we're going to be touching on our earnings. So in 2023, all of our numbers start at $2.32. When we look at our baseline EPS, we're projecting a 44% increase by 2028. Next, as we look towards our optimistic, we're going to be looking at a 53% increase. And finishing it out with our pessimistic, we're looking at a 16% increase overall.
So now taking a look at some of the risks that we see Coca-Cola facing. One of the main risks that we see Coca-Cola facing is regulatory risk. The beverage industry is already heavily regulated as it is, and expanding into different areas that brings on other regulations that Coca-Cola may have never faced in the past. An example of this is the sugar tax in India. Coca-Cola is sold in India, and Coca-Cola does pay this sugar tax, which leads to less revenue from that area. The next key risk that we identified was failure to new market expansion, specifically with our Asian market drivers. It's going to be very costly for Coca-Cola to expand into these new markets. And if they do fail, this will leave Coca-Cola with higher levels of debt. And finally, economic expansion. We do see potential for a bull market on the horizon, and typically consumer defensive stocks do worse in a bull market. And now moving on to the portfolio fit. So Spellman Fund currently does own some Coca-Cola. They own 95 shares, which has a market value of about $5,900. Currently, Coca-Cola holds a weight of 1.15% in the fund. The S&P 500 puts a weight on consumer defensive stocks at just below 6%. And currently in the Spellman Fund, we are a little bit underweight in the consumer defensive area. And we also only own 2 consumer defensive stocks. Coca-Cola makes up about 30% of that, while PG makes up the other 70%. When looking at our portfolio fit, we found that KO had a correlation with the fund of 0.58. And when looking at the other stocks, we found that there was 8 with a correlation above 0.5 and 25 with correlation below 0.5. And now taking a look at some of our valuation numbers. Using the PE method, we had a 1-year ahead price for our baseline of just below $65.50. And for pessimistic, it's just above $55. And for optimistic, it's just above $68. And then using the discounted cash flow method, we found an average value for the baseline of just above $57. For the pessimistic, it is just below $58. And for the optimistic, it is just below $57.
And then looking at our target price 5 years ahead, we chose to use a weight of 70% onto the PE method and 30% on the discounted cash flow method. We found an average target price across the pessimistic baseline and optimistic of just below $61. And currently Coca-Cola is trading at just above $62. So overall, our recommendation for Coca-Cola is a hold. Currently, it's trading at just above $62, but we have set our target price to just below $63. Including our dividend in the target return, we find to have a target return of just above 4%. A few reasons that we think that Coca-Cola is a hold is because it is the most consumed soda in the world. And one of the big reasons is because of Coca-Cola's dividend of just being below 3%. Also, Coca-Cola does have the largest market cap for the industry and low levels of debt relative to competitors. Finally, we see high potential of economic and population growth for Coca-Cola in key areas. And finally, we do see Coca-Cola as a low risk investment because it is consumer defensive and it also is a blue chip stock. Thank you all for your time and listening. If you have any questions, please feel free to ask.
I'd like to ask the first one. So can you hear me? Hello?
So you mentioned a sugar tax in India.
Hello?
Are there other countries toying with the idea of a sugar tax?
I'm not sure about specifically a sugar tax, but I know that India is one of the countries that does do that, and it has affected Coca-Cola.
What percentage of sales are in India? Because it's a pretty populous country, but are they a big consumer of food products?
It's still pretty low relative to the United States. I think we had a stat on there.
Yeah.
For our first growth driver, I should say.
It's on a chart with.
Can't remember though. Yeah.
Yeah, so.
2.4%.
Yeah. But there are countries in Europe that are looking to enact something similar or just outright banning some of the products that are used in Coca-Cola. But they have sort of adjusted their ingredients that they've used in the soda to account for that. So they're kind of already getting used to it as we speak.
Hello? Can you hear me?
Oh, Kevin, kind of.
Yeah, so I've been trying to ask for, I guess, the last two meetings. So you can hear.
Hold on, Kevin, we can't quite hear you. Technical difficulties.
Sugar is the #2 killer of people in America.
Try again, Kevin.
Okay, you can hear me now?
Yes.
Yeah.
All right. I was trying to ask questions in Exxon too, so, but that's okay. This group, by the way, you did a very good job of laying out, your reasons in the beginning. I have a question. It's amazing to me that they can drive up volumes by 10% on concentrate. You had that on a slide and you had finished products. Two questions. One is describe a little bit more what finished products are. The second one is how much of that 10% growth over the last couple of years was raising prices? I don't pay the prices at the grocery store because I don't like spending money. My wife tells me to leave and then she'll pay. But I understand that beverages prices have really gone up a lot. So can you expect that they continue to rise? I have a feeling a lot of the 10% is price. So two questions.
Yeah.
What is finished products and how much of that 10% growth was price?
What is finished products? Finished products is like what you get in everyday use. So like if you go out and buy a bottle of Coca-Cola or one of their off branches of drinks, that's more of what a finished product is compared to a concentrate, which is used in like restaurants for the most part. If you ever see like one of those soda guns, that's what the concentrate is.
I thought Coca-Cola didn't own their bottlers though, so. Or
Yeah,
did
they do have an off branch for the bottling as well, but it's still like under Coca-Cola's name.
When we're talking about the increases, you see that 10% increase on concentrate. We don't have exact figures on what of how much raised prices went into that, but you can assume with the high inflation that was a big driver of that growth. And as inflation, what we're seeing is it's starting to calm down. We can assume that product prices overall won't be inflating much, which could slow down the growth, especially in the concentrates area.
Could you go to your earnings per share slide then and let's figure out what the growth rate is for the next 5 years or so? See if that's your growth rates are reasonable. I think it was, yeah. So I'll pull this up. So 335 to 237 over 1, 2, 3, 4 years. Okay. So it's about you're growing, about 50% over the next 4 years. That seems pretty high, right? If growth is dropping.
That includes our other two drivers as well. I think that's probably why we see that number to be a bit higher. The driver one, as we mentioned, was the Asian markets, and driver two was the increase in consumer consciousness for the beverages. So those numbers are going to look a little inflated. That's just because of the work that we did for the stock, or like what we thought they could branch out to in the future.
Okay.
Yeah.
I'll let others ask questions, and unless they don't have any, then I'll ask again.
So to follow on his, Coca-Cola used to report case volume. So then you could see, was it actual sales, the number of cases they sold, case equivalents of soda versus the pricing element of it. So you always had that price increase plus that. And with a company like Coca-Cola, where 37% of their sales are US and 60% are outside of the United States, what was the currency impact? Did that, was that growth number higher or lower? And we were translating foreign sales in to US dollars at a favorable or unfavorable exchange rate. Typically, when they reported, if the currency was a headwind, they highlighted it. If it was a tailwind, they just talked about how they were executing on their plan, which is all companies do it. Foreign exchange is never something that just benefits them. So you were comparing dividend yields between the three investments. Is it always better to have a higher dividend yield? And can you go back to your Coke, Pepsi, Dr. Pepper slide?
So generally, dividend yield can be dependent on stock price. So I think it's important to compare what the actual dollar dividend is, especially with these three companies as their direct competitors. I don't have those figures here, but I believe Coca-Cola, when compared to price, is still favorable.
So if I'm looking at Coke, I say, well, I like that, I'm getting a higher return today. And actually, I think Pepsi is now at 343, which might be that the stock price fell between the time you calculate that. But what if the other dividends are growing faster?
We didn't look into the two companies, the competitors' growth rates.
So Pepsi's been growing earnings at 8.5% and growing their dividend between 7 and 8%. Dr. Pepper, earnings growth of about 11%, dividend growth of between 7 and 9. Coca-Cola's earnings were only up about 7%, and their dividends has been increasing by about 4 to 5%.
Yeah.
So you could actually look at those, say it's a higher yield today, but maybe I prefer one that's actually growing the dividend at a faster pace.
Yeah.
That's another consideration when we're just comparing straight yields to keep in mind.
Yeah, I agree. I think what we decided to factor into was our increases of revenue, also increasing the dividend, just because historically we've seen high growth in the dividend per year.
I like that you pointed out that there was a premium in the PE, the stability of earnings, the consistency in that. It's good. Sometimes we usually end up asking that question, why would you pay this? Yeah, so that was good. I'm a little concerned given the current political environment and some of the rhetoric out of the new administration that there might be some regulatory changes in the foods we eat. And sugar tax, I think, was bantered about in New York at one point. They were limiting bottle sizes and things like that. With the emphasis there, that seems like a risk. We still feel pretty good about the upcoming regulatory environment.
Yeah, definitely. I think that kind of speaks to their mergers and acquisitions department. They bought a lot of companies that are up and coming. So like Fairlife was one of them, Body Armor, both of which are seen as consumer, like good for consumer health. So I think that kind of diversifies them a little bit there. And then again, I think I touched on it earlier with like how they did have to deal with some of those changes in Europe. Didn't make a huge difference overall, just had to change out some of the ingredients in like the base Coca-Cola soda. As you know, that's probably like one of the more sugary drinks that they have. So it's kind of accounting for those things. And the good thing is they already have some of those recipes put together and the ingredients that they might need to factor that in.
And been able to survive significant changes in the recipe over time.
Well, I mean, when we're talking about something like the whole new Coke ordeal, how many years ago? Like there was so much backlash with that, so we could see something similar, especially in the United States. But because we've been working on this for like such a long time, I guess we didn't take into consideration much that the change that a new political environment, especially in the US, could have on the product. And just with how Coca-Cola's brand loyalty lies, how people could react to any changes in the formula.
Used to have cocaine.
Way
Back in the day, yeah.
I'm gonna ask another question now. You guys have said that this is a defensive stock, more stable, but I don't think you showed it in a slide. You know, that their earnings growth maybe is more stable than the market. You know, where's your evidence of this? Or can you talk us through it? I know I actually walked you, I think we walked through it once, but can you talk about it a little bit more?
Yeah, I mean, we go back to the first. Keep forward. Yeah, no, one more. There. Yeah, generally with these defensive stocks, they remain more stable. This chart here just shows the Coca-Cola stock price over the last 5 years or so. We focused a lot more of our time researching how it compares to the market, especially because it's a defensive stock. Dr. Spellman walked us through that, how we could do it on FactSet, and we found that the market consistently outpaces it over time, especially in a period right now where we're seeing general high returns throughout the S&P. So that's why our target return is typically going to be much lower than what, you know, a typical growth stock could be over time. But you do get that stability in downtimes. It's not going to, the price isn't going to drop as much compared to the rest of the market.
Yeah, I think you also said that we were underweight. You said it at the end in the portfolio fit, underweight this area.
Yeah, we're slightly underweight in comparison with the S&P, but there is part of the Spellman policy that I believe it is 5% in any given sector. It has to remain within plus or minus 5% of the weights of the S&P. Therefore, especially in this market, we're not necessarily too concerned with a 1% difference with the Spellman fund and the S&P when it comes to defensive stocks, just because we think the market will outperform them anyways.
I'd like to go back to the first question that Mr. Spellman had around earnings growth. Can you go back to your earnings slide? Wait, sure, go back. There's it. Okay, so you are projecting from 23 to 28 in your baseline 44% growth over that 5 years. So slightly whitewater math, less than 10%. 5 times, yeah, nine. Whitewater math, 9%. But then the previous years, just looking at the EPS, you didn't really have much growth at all. I think it was 220, 226, 221, 248, 247. If I looked at that from the earlier deck, or I guess way earlier. So I guess I'm trying to figure out, okay, if it hasn't really grown in EPS over the last 3 or 4 years, we had a bump to Mr. Spellman's point about maybe taking price. How, I mean, that seems like a pretty big jump from really not too much growth to all of a sudden, 9% across the board. So I'm just curious, because like even, look at 23, 24, other is the big one, right? That's not your growth drivers. So you don't really see a big jump, but then all of a sudden into 25, 26, that's kind of where you do see the growth. So what's gonna change in the next year plus that's gonna pick up growth over the last 4 years?
So within our model, we had to increase capital spending to pursue our growth drivers. So if we go back to the original EPS projection, yeah, we see that there isn't really much change within the next year or two. However, that picks up because we're expecting that the growth is going to accelerate in the future once that increase in capital spending generates into revenue.
Okay, so you're gonna spend money to make money.
Spend money to make money.
Alright, and then you have these existing product lines like the health and fitness stuff, so the Body Armor, Gatorade. Powerade, whatever, Aid. Did you actually break that out? Matt, I guess the short question is, did you make sure you weren't double counting? Like, did you actually pull that out? Cause how much cannibalism is there gonna be between, hey, I'm gonna spend $1. Mr. Spellman's wife is gonna go to Pick and Save and buy more Powerade instead of Diet Coke. Does that change, cannibalize each dollar of revenue? You know, what's the thought process around that?
Yeah, because the figures that we got from James Quincy during their investor relations, it makes up around 25% of Coca-Cola's revenue. We only applied what we'd spend to 25%. So, and then also involving the Asian markets, we expect to see high growth there, especially if it's aggressively pursued through increases in spending, and that could generate additional revenue as well. And that could really take off, especially considering the difference between the revenue they generate per person in the United States when compared to those countries, especially for a consumable product.
I think I asked the question very horribly, so given time.
I don't know if that was a good answer.
I think I didn't answer.
Better answer than it was a question.
Yes, thank you.
Yeah,
That's correct.
All right, I think we're out of time. We're gonna grab a picture of you if you wanna
Sorry.
pull up a good slide that'll work for.
Sorry, can I say one more thing?
Yeah.
I want to make sure they learn something. Can you go to the dividend slide? And I like, if other students are there, all of them to hear it. No, you got to do the dividend growth. All right, there's an error here. You said they increased 407% in the last 20 years, and you said average 20% per year. You forgot about compounding. If you do the analysis, 1.07 to the 20th power is 4. So essentially it's 7% growth per year, not 20. And that is one of the magics of investment that Einstein said, those who understand compound interest earn it. Those who don't, credit card debt, pay it. It's actually a 7% per year that gave you that, okay? Thank you.
Just want to start off by thanking the board members for being able to make it out today, taking time out of your busy schedules here for presentations. So the stock that we were looking for is Occidental Petroleum. This is presented here by Noah, Dave, Ryan, Bennett, and then myself, Brady. So just to kind of quick what we're going to be going over here today. I want to just point out the main things is to be looking at our financials, as well as looking into our 2 key growth drivers, which is going to be the Crown Rack acquisition, as well as lowering the debt. And we'll just finish off looking at a portfolio set and how fit in the Spellman Fund and give a recommendation. So it was founded in 1920 in the energy sector. Its main segments are going to be oil and gas, chemical, and then midstream marketing. Operations are mainly in the United States, but there also is some in the Middle East, North Africa, as well as Central America. Revenue drivers, we're looking at liquid natural gas, and then mainly the oil there. So they're involved in the drilling, which is going to be the upstream operations, as well as the conversion, which is midstream, and then the wholesale, which is going to be the downstream version of it. So key aspects we want to be looking at throughout the presentation is going to be that acquisition of Crown Rock, as well as the high net profit margins that come with that. And we're also looking at focusing on profit maximization through tech advancements, and then seeing high reinvestment to see growth. And then a project that they've been working on is backed by BlackRock and funded by them. It's going to be the Stratos emissions project. So that's just capturing CO2 from the atmosphere. And then also just looking at lowering those debt levels. So so the view we have on Oxy, we're expecting strong expectations of revenue growth as well as product expansion. So we saw a fair valuation of the stock price in the beginning of the year. It's now kind of undervalued in our mind as it has dropped down to about $48 right now. So, and you're seeing our market cap rate there is 46 billion about, and we're just kind of comparing that to ExxonMobil. They're sitting at 500 billion. So we just see a lot of room for growth in there. And then I don't know if anyone's heard of Warren Buffett, but he's owning that Berkshire Hathaway. So he actually bought some Oxy in 2019. This was right before the oil drop, and then he bought more in 2022. So he now owns actually 28% stake inside the company for this roughly about $13 billion. And that's just aligning well with the Spellman fund. You know, they're trying to see long-term revenue growth as well as returns. So we're recommending that buy right there, which is going to be about 100 shares, which is $5,000. The reasons for this is because of the high free cash flow valuation that we did. So we see that one pointed out a lot of good aspects for our company versus the other PE ratio one. So future growth we're going to see in projects as well as reinvestment. And then we're going to see some future political deregulation and U.S. oil production encouragement within the U.S. So and then last thing, just seeing that optimistic net profit margins.
So this is a price history and price comparison. This blue line here is actually Occidental Petroleum. The orange line is XLE, which is just the energy sector kind of average. And then the green line is ExxonMobil. So if you move your attention to 2020, so this massive dip here, that occurred because oil prices decreased to roughly $11. And right before this happened, Oxy had a surplus amount of reserves, so inventory, so that they had to end up selling at a loss. They were basically paying to give their oil away. But as you can see, their price recovered quickly in roughly 2 years back to around $50, $55. And then also here you can see that compared to the industry and compared to ExxonMobil, Oxy's price is a little bit undervalued at this point.
All right, so now we're going to move on to a little bit more of the numbers here. And the overlying theme that we want you guys to get out of this slide here is that we were able to recognize a direct positive correlation between oil prices and our revenue in the oil and gas industry. So in 2021, when prices were lower, we see that our revenue is also a little smaller. With the big jump in 2022, we also see a big jump. In 2023, it goes down a little bit. But if we look long-term, revenue prices in the last 10 years are increasing. So that's not to say that they're having bad years. So moving on to their revenue streams, being in the energy sector, they are basically very focused on the oil and gas, making up roughly 3/4 of their revenue. They also have their chemical and midstream and marketing, which are lesser, but also still incorporated in the company. So here on this graph, we want you guys to see that there are about 3 or 4 periods of revenue going down over the quarterly, but we always see like a bullish impact following that. So now here in the end of 2023, in the right here, we are hopeful that we could see this going forward as well. So moving on to the ESG, they are one of 3 companies to establish a net zero plan. They hope to achieve this by 2050 with intermediate parameters. They also hope to achieve this through innovation and innovative technology, such as their Stratos experiment, which is a direct air capture new technology that they're implementing. They're also a part of the Oil and Gas Climate Initiative, which is a 12-member CEO-led climate initiative that is all focused on environmental stewardship within the oil and gas industry and achieving net zero.
All right, so now looking at the risks, we weren't able to identify any significant risks at the moment. The biggest risks that we're going to dive into a little bit later are their political risks. With new different policies coming in, possibly promoting business in the United States, we believe that this could have an impact on both the demand and price of oil. And this is something that we're going to dive into with our pessimistic and optimistic valuations.
All right, so moving to the financials, I wanted to focus on the plowback ratio, dividend ratio, net profit margin, our debt to equity. So what the plowback ratio and the dividend ratio show to us is that right now, Occidental Petroleum is a high reinvestment company, but in the history, they did give a high dividend. We'll talk about that a little later. So right now, the dividend ratio is 23.4%. And we can kind of see that their acquisitions that they made from 2021 to 2023, they're starting to pay out. So they're starting to give more of a higher dividend. And we think that will trend in the higher direction in the future years. And then if you look at the net profit margin, we're a little bit ahead of the industry average. But with the recent acquisition of Crown Rock, we think that the net profit margin will actually increase because of the location of Crown Rock. And then our debt to equity, just a little story, back in 2019, their debt to equity ratio was actually 200 and reached over 200. So what we can see is that they've set targets to reduce their debt over time. So many investors saw this as a con, but now we believe that they're setting targets to reduce this, and they have targets to achieve this by 2026. So what is Crown Rock? Crown Rock is a $12 billion purchase in August, and it's a private oil company, oil and gas company that not a lot of people knew their financials. How this was acquired, it was $9.1 billion in new debt, $1.7 billion in equity, and there was existing debt of $1.2 billion. So what this has to offer, it's in the Midland Basin. They have 94,000 acres in the Midland Basin. Oxy has 22,000 there right now, so they're increasing that dramatically. And also there's 1,700 acres of unused drilling sites. So we think that their production will actually increase by 4% year over year until 2028. And then the 22% increase in the Permian Basin, Oxy has 584,000 barrels of oil equivalent per day. And with Crown Rock, including in this, it will be a 22% increase in the Permian Basin, which is the mecca of oil production in the United States. And then also overall in the United States, Crown Rock will increase their production by 17%. And then looking at the earnings per share, as I said, the production rate will be 170,000 barrels of oil per day, increasing by 4%. How we found our net profit margin was basically based on the break-even price. They had a break-even price set at $40 and possibly sub $40. So we set that at $40, and that's where we're getting these higher net profit margins. And then also our barrel price. Since it's located in West Texas, we use the West WTI, so West Texas Intermediate Oil Price Predictions, and they had a prediction of $95 a barrel in 2028. So we took the current oil price average and we grew that by a percentage over time, arriving to 3.28 earnings per share. So then if you move to pessimistically, we grew the oil price at a slower rate, ending at $75 in 2028, and that will affect our net profit margins and earnings per share. And then optimistically, it grew all the way to $105 for barrels, and then you'll see that our net profit margin increases to 61%. We think this does seem high, but we think it's achievable with a break-even price of $40.
So just to talk a little bit more about the company's debt, this graphic was taken from their Q3 earnings call. On your guys' right side, it shows what parts of their debt they actually paid off during the third quarter. But I want to draw your attention here to the left side and where they got that money from. They actually acquired $1.7 billion by selling off a good chunk of their non-core U.S. onshore divestitures, which the non-core just means that they were performing below their standard of what they wanted to produce per day. So they earned $1.7 billion worth for that, and then the rest of the 2.3 was financed just using excess cash. And so a little bit more information about their debt levels. From 2016 to now, they've actually decreased them by 50%. We think a huge reason for that was Vicki Hollub, who joined as their CEO back in 2015, promoting a debt reduction strategy. And then in Q3, we saw the $4 billion reduction in debt. They are projecting an additional $0.5 billion to reach $4.5 billion mark by the end of 2024. We also see a potential for interest rate expense savings if they continue to deplete their debt levels.
So now putting this growth opportunity into earnings per share. So we expect a smaller earnings per share of 7 cents increasing in 2024 due to the interest that we'll be saving. And then over 2025 through 2028, we expect a steady increase in earnings per share by 18 cents. And this is due to the debt being reduced by $4 billion in 2024. And we expect the goal to be reached of 15 billion by 2026, and overall this will increase the net income. And then looking at the pessimistic and optimistic scenarios, for the pessimistic scenario, we came up with the assumptions that there would be an additional $500 million in debt reduction during Q4 and reaching the $15 billion goal by 2027, which gives us a total of $640 million in interest savings. And then for the optimistic scenario, we projected that there would be a $1.5 billion reduction in Q4 and that they would reach the $15 billion of debt by 2026. And this gave us a total of $761 million saving by 2028.
And then to talk specifically what happened this year. So these are the 3 quarters expressed in total debt as well as the short-term debt. So we saw quarters 1 and 2 stayed relatively same, but then the third quarter, we saw a huge rise in their debt. That's because they were financing their Crown Rock acquisition by taking on about $9 billion worth of debt. But one thing I want to point out is that the short-term debt number has stayed relatively stagnant. So we see that they are enforcing more of a long-term debt strategy as opposed to taking on more debt in the short term. We think this allows them to give more flexibility within the next 2 years to either put more back into the company or to possibly give out dividends. And then we'll express that using this slide here. This shows all debt that is maturing within the next 2 years. All 24 debt is all paid off. We see 1.5 billion maturing in 2025 and then 4.1 in 26, but then over $19 billion maturing after the year 2026. Once again, this goes back to that long-term debt strategy that the company has faced. So we think the next 2 years for this company are really crucial. We see it as a good time for them to not focus too much on paying off debt and give back more to the investors or back to the company. So now putting all of these numbers into our valuation, we took all our growth opportunities and we expect the total earnings per share to reach $9.53 by 2028. And then we projected this both optimistically and pessimistically. And we believe our optimistic calculation will give us an earnings per share of $10.26 by 2028. And pessimistically, we'll get an earnings per share of $8.03 by 2028. And then the valuation, this was one of our strong points using the free cash flow method. This gave us a baseline average value of around $100. And the price to earnings, that gave us a baseline value of about $55. So to give a conservative estimate, we weighted the price to earnings ratio at 90% and the free cash flow method at 10%, which gave us a baseline of $60. And with the current price being around $48, that's around a 25% increase. So this is how the stock will actually fit in the fund. Currently, the Spellman fund correlation is at about 0.41, which is a moderate correlation. But we want to focus more on ExxonMobil there at the top. Obviously, 2 oil and natural gas companies going to have a high correlation. But we think the 2 key differences between the company, number one, ExxonMobil is about 10 times larger than Occidental Petroleum we saw with the market cap numbers. And then the bigger one, Occidental Petroleum has a higher percentage of domestic production as opposed to Exxon. Exxon earns a lot of their revenue through production overseas in other countries, whereas Oxy focuses specifically here inside the United States in the Texas, Colorado, as well as the Gulf of Mexico. So if we have 3 essential things that we want you guys to leave this presentation with as to why we believe this is a strong buy. First one, we believe that the new administration coming in January will prove to be very effective for Occidental Petroleum. A need for higher tariffs on exported goods, lower amount of imports will encourage more energy production and oil production here within the United States. This is why we think Oxy has a huge competitive advantage with other companies like ExxonMobil. Next, we talked a lot about our Crown Rock acquisition and our long-term debt strategy. We see currently that Crown Rock is up and running, and it is proven to be better than they are anticipated. They increased their Q4 projected production by 9,000 barrels a day. So they're already anticipating that getting on a hot start. And then finally, if we exclude that COVID dip in 2020, the stock is currently at a 17-year low. So if we base it on the whole sell high, buy low method, right now we believe that this is a perfect time to buy into the company while the price is low. We've even seen a year-to-date price drop of about 20%. So just to wrap up and give our final recommendation, again, we are proposing that 100-share buy for about $5,000. To put that in perspective, that'll bring the energy fund to about 3% of the total fund. And then hopefully we can reach that target price of about $59 and generate the target return of 25%. That concludes our presentation. If you guys have any questions, we will take all of those now. Thank you.
Start on your risk slide. So a company that's almost 100% dependent on the price of oil, you view that as a very low risk?
So it's not so much, so the significance is pretty high. So we see that the demand and price for oil can have a huge impact on the company. Hence why we put it in the upper region here, but we don't think that the demand and price will drop. So that's why we have the probability as a little bit more optimistic that this won't be a huge risk for the company. If it was a different time, like if we were measuring this 4 or 5 years ago, perhaps all that information would be shifted more to the right because we think there's a higher probability. But based on our research and everything we have found, we don't think it actually has potential to drop, but it will still have a significant impact on the company.
Does that jive, Tyler, with what the market is telling you in the futures market?
Well, here's we might have looked at some other prices, because the futures curve is in backwardation. It's pointing down, implying lower prices in the future. And your projections were all for higher prices over time. So 2 different sources, which is fine. It's good that you have different opinions. You also pointed to a time within the last 5 years where oil prices were negative and told us that the break-even price is $40. So to me, it seems like I would probably put slightly higher probability on declining oil prices, especially, I know this is finance class, I'm gonna throw some econ at you. If we have a regulatory environment that, allows us to increase production, drill, baby, drill. What happens if we increase supply? What happens to price? So is that a good thing that you have increased decreased regulation and increased drilling activity?
I think it depends on who you're asking because in what we've seen in growth with a lot of AI data farms, we anticipate that the demand for different sources of energy is going to go up. So it's all a matter of how much you weight increase in demand versus increase in supply over the other. And then in terms of our pricing model, if I remember what slide it was on, where we might have gotten the different information is we were basing it on the oil produced just in Texas. Because that's where CrownRock is exclusively in. So that's where we might see a little bit of a differentiation. It's a different kind of oil. It's a lighter oil. There's a lot of differences between them. But it's all dependent on whether or not we see that demand go up, which we are everything that we've seen is pointing towards that it will.
CrownRock was $10 billion. What was the
12 billion.
12 billion. Yeah. Big acquisition relative to Oxy or small?
Big.
In terms of production, not in terms of acreage, the 94,000 acres actually only represents roughly 1.2% of all their acreage.
Okay.
But in terms of production, as you can see, it's large. So they have, like I said, the 584,000 of barrels of oil equivalent per day. Oxy would be having an additional 170,000 barrels of oil equivalent per day.
So you talked about COVID, but right before that, why do they have so much debt?
They made multiple high risk acquisitions with debt. And so since they purchased it right before, and the oil prices dropped and they almost went into bankruptcy basically at that point.
So Anadarko was $55 billion. To put it into context, Crown is big, but they've made bigger acquisitions.
Yes.
Maybe lessons learned. But that's interesting. Do we want them to pay down debt? What if they plunked that? What if they did something else? Couldn't it be better for shareholders?
I think so the biggest thing that they wanted, it's all about looking
how much would investors want the company to reinvest back into the company and how much would they want to pay in dividends. Before COVID, we saw dividend payments of about $3.8, $3.9 a share. Currently, it's sitting at 84 cents. What we are guessing is that they're gonna try to get back to those numbers. So I think with how they've played out their debt strategy is they're hoping to decrease that plowback ratio, have to spend less money bringing back into the company to reduce debt and try to get that dividend number back to where it was pre-COVID, because that messed up a ton of stuff for the company. They had to hit the reset button, but they're pretty much on the right track to get back to their numbers before the COVID pandemic.
And then additionally, their high, like you said, the high debt isn't necessarily a terrible thing. They, in the prior years, they've been reinvesting a lot of their finances into new productions. And we think that we're kind of at that middle ground where we think those acquisitions like Crown Rock are gonna end up trending them in the upward direction.
So, interest, you talked about the interest savings. How much is interest do they pay? Do you have a per share number?
Their total.
And by the way, I'm asking these questions because you guys did a nice job of presenting. I asked the harder questions for the group, so.
Thank you, appreciate it.
Yeah, so do you have a per share number from the debt?
We don't have a per share number for millions.
You know, just the average term rate on their debt.
The average term rate was 5.27.
So one of the questions, piggyback off of what he was thinking was, you made a comment, you know, we have 2 years of a run rate until we need to start thinking about this debt, file back in or pay dividends. What would you guys do? You're the CEO.
I think the biggest thing, if I was in Vicky's shoes right now, we have seen so far in just the one quarter that Crown Rock has shown, this could be a huge profit booster for them. With that being said, I think in those 2 years, allowing this production to grow would be a lot easier to pay off their long-term debt that they're putting off past 2026 then. So right now, I think it would be a good dividend period to reward investors by getting back to their old dividend ratio numbers. If I was in her shoes, because of how optimistic we are about this acquisition and how much it's already produced.
What's the conservative method? If you were gonna be more conservative, what would you?
What do you mean?
Well, you have a big credit card statement that's due in 2 years. You gonna go out and buy a new Tesla every year?
No, but what, I mean.
And then let me, I'm kind of throwing that out there, being smart, but dividends, right?
Mm-hmm.
You say, I'm gonna give you a dividend. You're basically making, it's a signal that you're saying to investors, we think good times, like you're saying, you guys are pretty confident good times are happening. You've seen volatility and what it does to earnings, to stock price. You have debt that is not volatile. You know what you have to pay, right? If you signal to investors, hey, we're gonna start increasing that dividend the next 2 years, and then all hell breaks loose in 2 years, oil prices decline, your EPS drops, are investors gonna be happy when you go to them and say, we've got negative EPS because, but we're still maybe gonna pay you that dividend, or maybe not, but we have interest payments to make? So there's a conservative route that you can go, which is, you know, yeah, we'd like to increase your dividend, but we know we got this big bill coming due. Maybe we should focus on that for the next 2 years so we can get our debt back in line with quote unquote industry standards. So there's a trade-off, and it's more of a learning type of situation for you guys than any kind of putting you on the spot, because when you said it like, oh, there's some opportunities, like, well, you know, you have to make a decision, and she's making that decision now. Dividends are nice, but if you're playing the long game, you got a big, in Vegas terms, nut that's coming due in 2 years, and you want to think about that and how that's going to affect your decision versus playing the short game to hopefully spike your stock price in the next year or two. Because usually when management teams do that, they get burned, especially in a commodity business where that oil price moves a lot, as you guys have seen in your analysis. So something to think about when you guys become CEOs. Always play the long game.
Yeah. Just to add on to that, like, I think it's also important to make sure that what they're reinvesting is going to going to an asset or something that is gonna produce a higher stock price for them. And I think with Oxy, with their reinvestment, I think they're doing that in a beneficial way.
Well, no, I'm continuing.
I was going a different path.
Well, let's go
Buying back
let's go
shares,
back to
but-
your, yeah, but you can buy back shares, which I wonder, in my mind, a couple of different things, which again, this is gonna get into cocktail hour, but go back to your ratios. So you said that the term on debt was, because I think we're probably gonna go in the same place, right? So your term is 6.5 or whatever, would you say the debt amount was on the average,
What the
the average debt rate?
It was 5.27.
Okay, so your return on equity is 13.06, right? So if your debt, you're paying less on your debt than you're getting back on your equity. That's kind of your,
So if you make $10 a share at the current debt levels, I could pay down debt, have more higher earnings, maybe it's $11 a share. Or I reduce the share count, which increases the earnings per share. So then it's a question of, is the interest expense savings on a per share basis outweighing what the share buyback would do for those shareholders? So if you went into really simplistic terms, we make $10, we have 20 shares outstanding, that's 50 cents a share. If we pay off that debt and it increases, or excuse me, if we leave the debt outstanding and decreases earnings by $1 or $2, now it's $8 a share, but we bought back half the stock. Now it's 80 cents a share. So it's, you get a more earnings power per share by having that financial leverage, by keeping the debt outstanding, but then you have a riskier balance sheet. In tough times, you have a bigger nut to cover because of that interest expense. So the conservative move is you pay off the debt, you reduce the debt so that you have a less risky balance sheet. But you do it to the detriment of the shareholders because you're not buying back shares, you're not reducing share. So you supplement that by paying a higher dividend, 26% of your earnings, to keep them happy until you can start reducing share.
And that does help our understanding a little bit more, because in their earnings call, she kept referring to wanting to strengthen the balance sheet. We didn't really know exactly what specifically that was referring to, so.
80% debt to equity.
Yeah, that's what she's talking about.
that's the
In a commodity business,
that's scary.
that is seeing price decrease in a market that's a 27% debt to
Yeah.
equity. That scares me, honestly. That's a lot of leverage in a commodity business.
And it's why you saw it underperform so dramatically when they acquired Anadarko Petroleum, took on a huge amount of debt, and then commodity prices cratered. And you saw on your chart, the severe underperformance because they were a leveraged business.
So I think the decision you would want to make, and correct me if I'm wrong on this, but if your earnings growth is going to be higher than your debt payment, you'd want to be more interested in buying back shares because your bang for the buck would be bigger, right? So.
There's a formula for it somewhere.
Yeah, there's somewhere. So simplistically, like, let's take it out of the corporate life and into everyday life. I'm paying a mortgage on my house at 2.75%. I can get a money market at 5%. Does it make more sense for me to pay off my debt or put more money in the money market based on those two returns?
Tax bracket.
Not yours, unfortunately. So that's what you have to decide. You get a higher rate by putting in money market, but if all hell breaks loose, I lose my job, maybe I should have paid off my house. So these are the kind of decisions you guys are gonna make, and we're not really asking you guys questions, but this is, I think, really helpful for you guys as we think about things.
Very helpful.
Could you quickly go to your pessimistic scenario and talk about your price per barrel projection and how you came about that?
So for them, we mainly just kind of took so there's the Brent predictions as well as WTI. So we went more with kind of what Brent was going with, which is overall oil. So that's like we said before, ours is lighter, more pure. It takes less time through the process to turn into oil that we can use. So that's why it's like a lot better. It's cheaper to do that. So we kind of just took it more towards the Brent predictions for that, just to see like if we're like start shipping like more overseas, something like that. Then when that happens, it'd be more towards that lower price rather than the 95 that we'd be selling to US like from
I'm no commodity expert, but when I look at that, it seems like, hey, a slight increase, that's not too bad. When I think of a pessimistic scenario, I think of something more severe. Did you guys like stress test what this would look like if maybe you dropped to $50 a barrel instead of staying stable?
I guess we actually didn't, but we were certain that Crown Rock's break-even price was 40. So I guess we didn't stress test it. We should have, but
Sure.
It'd still be making
But
money on it if it dropped down to something like that. And we're like, we didn't check to see if something as big as like COVID or something happened where literally it drops to like nothing. So obviously that would affect it the same way it did before, so you'd see that drop. But they're taking like precautions this time and obviously lowering that debt and doing stuff like that. So then if that happens, we're not going so far below other companies and like the average of the market too.
Okay, thank you.
Something to think about before, or cocktail hour. Why isn't Buffett bought he's raising all this cash? They've taken the rich hit. Why doesn't he just buy the whole company? Something to think about before we have cocktails. Come up with answers.
It was why Buffett.
Why is he not bought the company? He's been raising cash like a maniac. He's sitting on a boatload. He could probably buy this thing 7 times over.
Yeah, he said he's staying off the board and it said mainly he kind of liked the current administration that's controlling it. So he was like, I don't wanna try and intervene when they're already doing so well with.
He has a history of doing with companies that he owns.
Wasn't it we had Coca-Cola and Oxy? Are we gonna hear from Dairy Queen or any of the other Fruit of the Loom?
Thank you. He owns Fruit of the
He
Loom.
does, I know.
All right, thanks.
Good job. Thank you guys. Good afternoon, everyone. My name is King. I'm here with Luke, Lacey, and Joseph, and we're gonna present our analysis on Intel. So just give you an overview of what we're gonna talk about today. I'm gonna brief you through the business overview, the revenue breakdown of the company, some risks associated with Intel right now, so the financial ratios that we extracted from the 10K and 10Q, some key growth drivers that we think that Intel can rely on for its future earning, which is client computing group and data center and AI, as well as its valuation, which we recommend a hold right now. So some key findings from our analysis is that we recommend a hold. The reason for this is that we find that there's not significant undervalue, nor it's significantly overvalue for a sell and buy. However, there are like some challenges recently, especially this week, that the CEO retired, more like being forced to quit the company. So there are some challenges in the Intel foundry business that we think that the company has to address, as well as the CHIPS Act dependency, which means, well, we'll explain later in our analysis. But albeit the uncertainty, we believe that the stronghold position was still valid if the company is able to address the issues.
So a little bit over the overview. So Intel is currently within the fund. Year to date, they have about a negative 51% return. As of closing yesterday, it was trading at about $20.80, but it has gone up to $20.92 closing today. It only holds about 0.96% of the total fund. It's kind of sitting around $9,500. They are again currently facing some profitability issues. But their position in AI and cloud computing do offer a little bit of potential recovery. Their intrinsic value does suggest some upside as it's currently priced below its full potential. And then they do remain a key player in the semiconductor industry because of their strong brand recognition and their diverse range of products. So again, like Kang mentioned, we are recommending a hold right now. As for, again, their business overview, we can see that, again, they are global leaders in semiconductor industry. They have shifted more toward a data-centric, so things like cloud computing, AI, autonomous driving that are really helping them. They do offer, again, products over data centers, memory, IoT. Their main profitability revenue streams are CCG and DCAI. They currently make up about 80% of their revenue. And then their EPS is also projected to improve significantly by 2028 just because of DCAI and CCG.
So we are recommending that hold with our target price being almost $27. As of yesterday, the price did drop down to just under $21. That's influenced our target return. Before the price drop, it was at around like 12.5%. As a business, they are shifting more from their processors to moving more to like data centric focus with their cloud computing, AI solutions, as well as autonomous driving technology. We identify their key drivers being that cloud computing group and the DCAI, with their revenue streams making up over 80% Intel. As for risks, if they can't get a strong footing in the AI market, could lead to some serious profitability issues, as well as like this leadership change. We don't really know how the future, what the future will look like for the company because they haven't named anybody as a successor yet. Looking at the stock price over the past year, it's just keeps trailing downwards. Year to date, down almost 57%. Over the past year, 50%. We see negative ROE, just going down ROE, EPS, all down. As for their revenue.
Some enthusiasm.
As for their revenue segments, projected growth, again, everything's down. The only promising thing here is their Mobileye, which is their autonomous driving technology. Year to year, like I said earlier, the desktop, notebook, DCAI, these are all like the client computing group. Again, just making up, it pretty much stays the same every year, 80% of their revenue stream. So to go a little more in depth with their client computing group, this is their processors for their computers. They have direct competitors with the Ryzen chips from AMD, which have become a little bit more popular in recent years due to Intel's performance issues. Apple has their own processors, and then like NVIDIA's GPU and chip solutions. As for DCAI, this is making chips for AI solutions. So they have their Xenon line, as well as their accelerators. This is their Gaudi chips, as well as they make their own GPUs as well. Again, NVIDIA, AMD, these are their main competitors in that sector. So for Intel, looking forward, they do have promise with their Gaudi chips, increasing performance and energy efficiency with these new chips. As for their client computing group, they want to have these processors, again, just they're really going all in on this AI thing. And then another promising outlook is for their foundry service. This is where they make processors for other companies. This comes with the CHIPS Act. They want to, like our US government wants to move chip manufacturing from China to the US. And then with the leadership change, this has kind of become shaky. They don't really know what's going to go along with the foundry service, but there is upside with the foundry service. So for risks, our main two risks were increasing competition. Like I said, if they can't get that footing in the AI field, there is a high impact to their profitability. That goes along with the chip stagnation. If they can't compete, if like right now, their nodes on their chips aren't as good as the competitors like TSMC and AMD. So if they can improve their chips and get in front of the curve, high probability for impact to the profitability. Looking at financials, like just really bad. Negative profit margin, negative 125%. This whole past year, they've been really investing, like I said, in that foundry service as well as their data center and AI solutions. But looking back a few years, they were competing with the industry. Something to note is like they are taking on a little bit more debt, but it is pretty comparable to where the industry is right now.
So moving into their debt, they currently hold about 51 billion in debt. However, they do have a debt to equity ratio of about 0.48. So this might suggest a more conservative reliance on their debt and help a little bit with financial stability, though not too much. Their average interest rate on their bonds and notes and stuff is about 4%. However, it can range from about 1.5% to 6%. And they currently have about 4 billion maturing within the next year. But the bulk of their debt is these longer term bonds, so we won't see those mature for a while. Moving into ESG, some of their pros are they do have ambitious sustainability goals. Of a goal of 100% receive globally, some net zero emissions in scope 1 and 2 by 2040, and then by 2050 they want net zero in their scope 3. They have been making significant improvements. They're at about 99% global renewable electricity. And then their green bond initiative is also one that they invest in heavily. However, some of their challenges with these, the scope 3 emissions is heavily reliant on their the end customer basically. So there's not a whole lot that Intel can do with this. They are a resource intensive company, so it takes a lot of water and electricity and energy to kind of create their products. And a lot of their goals are longer term, so there's a little bit of concern within the short term progress of their ESG goals. However, because of the improvements that they're making, we do still rate this company favorably in terms of ESG.
All right, so next we're gonna be going over the growth drivers and valuation. And we derive our calculations through 4 different methods. These are based on the free cash flow model, the PE method, dividend discount model, and the tangible book asset per share method. And so for our optimistic value, since the CEO recently stepped down, we do believe that this value more so reflects our baseline value. And for that, we have a value of $26.85. For our pessimistic value, this accounts for ongoing challenges and negative cash flows for Intel. And for this, we have a value of $18.66. So for the first big growth driver for Intel, this would be the Client Computing Group, or the CCG. This also happens to be Intel's largest revenue source. Client Computing Group accounts for over 50% of Intel's total revenue, making it a critical component of the company's total financial performance. This ties directly into Intel's AI-driven PC growth. Intel's focus on AI integration in its products, such as the new Core Ultra chips, position it to capitalize on the growing AI-enabled PC market, which is expected to grow from under 10% of the market today to over 50% by 2026. Now looking at an optimistic scenario for the CCG, based on a few assumptions, we can see that with a compound annual growth rate of 8% per year and net profit margins of 30% by 2026. We can also see that if CPUs decrease at a constant rate of 5% per year, considering that its competitors will catch up and gain more market share, we can see that net income will increase from $9.75 billion to $11.4 billion over the 5-year span. And we can see that earnings per share will increase from 2.16 to 2.53 from 2024 to 2028. Something to note here that is good for the company on the optimistic side is that even though Intel is losing market share here, since NVIDIA and AMD are catching up, we still expect it to be profitable. Now on the pessimistic side, despite Intel's best efforts, the CCG net profit margins will remain constant due to that intense competition, higher production costs, and delayed product launches. And for this, we'll use a net profit margin of 25% based on Intel's historical performance in this sector. And based on Intel's historical performance, we can see that net income remains relatively the same, around $9.75 billion over the 5 years. And EPS remains relatively the same as well, fluctuating around 2.1 to 2.17 from 2024 to 2028. Intel's next big growth driver that we found would be its data center and AI, it's DCAI. And DCAI offers Intel specialized solutions to designed to optimize performance for cloud, network, edge, and high performance computing customers. Intel is advancing its AI technology by producing processors and accelerators, which is aimed at doubling performance, enhancing large language model processing through its Xeon and Core Ultra chips. Its Xeon chips are more so optimized for its high performance computing customers, and then its Core Ultra chips are more optimized for its AI large language model processing. And then we have multiple projections indicating that growth rates will fluctuate between 25 and 35% for the AI market from 2024 to 2028. Looking at the optimistic scenario for DCAI, based on a few assumptions, we can assume that a growth rate of 25% by 2024, and this will rise to 30% onwards of 2027. And then we also assume that Intel will be able to capture a 7% market share of the DCAI sector. Now, based on these two assumptions, we can see that net profit margin will grow from 0% to 7% over the 5-year span. We also see that earnings per share will go from $0 to $1.77 over this 5-year window. Now, on the pessimistic side of things, we could see a decreased market share where Intel isn't able to capture the full 7% of the market but it will slowly shrink to 4% by 2028. We could also see an overestimation of the AI market, and for this, we'll use a compound annual growth rate of 13% instead of 25 to 30%. And then we can also see a smaller margin for AI sector as a whole, anywhere between 2 to 3%. For this, we would have net profit margins only reaching 3% by 2028. And then for earnings per share, we'd only be able to get to 12 cents by 2028.
So for the, this is just a breakdown of the EPS for each sector that we come up with. So as Joseph mentioned, most of our drivers come from CGG and CAI. For other EPS, it's mostly driven by their foundry system. So according to our research, Intel is expected to get the break-even point for their foundry system by 2027, but we kind of leaning toward 2030. So that's why the EPS for other EPS, it's probably not going to become zero by 2030. The table below is just a breakdown of 3 different scenarios for baseline, the pessimistic and optimistic scenario. In our baseline, the EPS by 2028, we expect it to be 2.7. In pessimistic scenario, it will be 1.7, and in our optimistic scenario, it's going to be 4.3. For the valuation, we use 4 different methods. The main reason for that is when we try to come up with our free cash flow model and our PE method, it happens that we expect Intel to experience some negative income in the next few years. So that's why we shift toward our dividend discount model and our valuation tangible book asset per share. For the dividend discount model, it's a little bit tricky because Intel suspended their dividend recently, but overall, it's still, we think it's more predictable and easier to calculate compared to the other 2 methods. For the value of tangible book asset per share, it's very close to what the Intel's lowest price dropped this year. So we believe that it's pretty accurate. The detail on the calculation is also provided in the appendix. So for the 3 scenarios, we said that in the baseline scenario, Intel's stock could reach 26.8. In the optimistic scenario, which is pretty much very hard to happen at this point, it's going to be 34.5, and our pessimistic scenario is going to be 18.6, which is very close to their tangible book asset per share. So this is like the breakdown of our baseline valuation of Intel. We expect it to reach 30.8% to get return by 2028, and then that's the reason we recommend a hold.
So as for how it fits in the portfolio, it does provide some growth potential and diversification benefits without contributing an excessive amount of risk, just because it only does hold about 1% of the whole fund, like we mentioned before, sitting around $4,900. If we break it down into just the tech stocks that in the fund, it still only holds about 4%. So it's not a significant amount of the fund, just in case increases or decreases, it doesn't really affect too much how it will sway the fund. The correlation sits at about 0.54, so it's a moderately correlated with the fund's performance. So it does kind of also reflect within the tech sector. It is important to note, though, that because of the dividend suspension and the declining performance, it is a little bit concerning. However, calculations do kind of indicate that they could potentially reinstate their dividends if their financial performance kind of increases again. So just kind of wrap up everything, we can see that the growth in the AI sector and the chip segments are really helping their growth potential. They do, again, have some moderate debt financing, which is why we're recommending the hold. Our target price is currently just under $27 with a target return of about 30%. However, like King mentioned with the step down of the CEO, it's kind of up in the air right now. At the beginning of the week, we had a target return of about 12%, which kind of correlated a lot better with our hold recommendation. So that's just an
So you must have been reading my mind, which is scary, because I was literally looking at the dividend.
Dangerous.
I know.
Dangerous territory.
Back reasons that's scary.
Yeah, no, I was literally, as you were talking about the dividend discount model, and I'm like, I thought they don't pay a dividend or And then I looked and it looked to me like they did, and then seeing that the payout ratio was like 200%. Something. When did they suspend the dividend?
I believe it's Q2 this year.
It's been a couple quarters, so they haven't paid anything.
So it's been like like last quarter didn't pay anything at all. And they don't have any plan to, I mean, they haven't really announced any plan to resume it, so.
Yes. So if they're not paying, if they suspended their dividend, walk me through how you're able to come up with a price using a dividend discount.
So in my calculation.
I haven't done the CFA level 1 in so long, it's.
So, yeah, I mean, I use a lot of assumption in my calculations. So what I've seen, the pattern is they usually revisit their dividend payment plan for like every 2 or 3 years. So
Appendix page 2 for those following along. 28. Yeah. So that might be helpful for you to.
Yeah, so I just try to assume that they would have like in the optimistic scenario, I just assume that they would resume their dividend payment by 2026 because they're trying to cut a lot of costs for the company, and like every 2 or 3 years they just revisit their dividend and increase by $0.2. For the pessimistic on the other page, I said that they might resume a little bit later in 2027, but they don't pay as much as they do in the optimistic scenario. So the variation that I come up with for both scenarios, I think it's kind of very close to their current price. So,
Yeah, because I wasn't following. This is helpful. So I'm assuming 28 is the optimistic. So in 2024, okay, so they cut. And you got the 0.8. In this case, 80 cents in 26. What was prior to them? Do you know offhand what the 2023 dividend payout was?
I'm pretty sure it's 0.8.
Okay, so basically they're taking it back to what it was.
Yeah, and 2022 would be 1.1 or 1.2.
Okay, so they've been cutting it.
Yeah.
I just didn't see that history, so. Okay, that's helpful. So you came up with a DDM based on your expectations that they're going to reinstate the dividend and eventually grow over time, but.
Was there any discussion from management as to when they expect a return to profitability?
That's a very tough question that we try to, I think like initially we actually think that the foundry system would be the main profit source for the company. But then the plan was like to build that or to finish that by 2027. So it doesn't really matter in our calculation. And now like when the CEO stepped down, the CHIPS Act, which would contribute like 8 billion to the company, it's kind of up into the air because the former CEO, he wants to build a foundry system, which will drive their profitability by 2028, 2029. But then there's certain condition in the CHIPS Act that said like you cannot use the money for different sectors or different segment out rather than the foundry system. And it seems like the current board right now, they don't really want to, or they really like that idea of like building a system for just Intel because since the building phase, the foundry system only just like build chips for Intel, and they rarely have like any other customers aside from the company. So they're making a lot of losses from that sector. So the answer is no.
Okay, it's interesting because it doesn't seem like that long ago, but when we were in college.
That was a long time ago.
Everybody, yeah, you were there. You had the Intel Pentium processor, and then the Pentium 2 came out, and then the Celeron, then the Core Duo. It just seemed like they were the only one. I think they had an 80 or 90% market share, and AMD was literally around just so that they didn't have any Department of Justice anti-monopoly legislation come down on them. And now all of a sudden AMD is eating their lunch. NVIDIA comes out of nowhere. Taiwan Semiconductor was another one I think you guys mentioned. And it just seems like they're still here. I have one of my, it's a i7 which I think was their chip from 2011 or 2008, because we don't invest in new technology at my company. But it just seems like
We're employees.
right. The cycle, the refresh cycle seems to have slowed. They don't seem to be innovating, and they seem to be heading down that path of Kodak. You guys remember Kodak? Before everybody had a camera here, you had your own camera and developed them. So just, it seems like a really tough sell to me to put a scenario together where it gets back to this golden age. It just seems like they're trying to come back from the dead to me. So I have a hard time with that. But that said, if our valuation is $26 and it's currently trading at 20, and we're recommending a hold, I mean, if we believe that number, I would have thought we'd be looking at a buy.
Yeah.
Seems like a decent return if that's true. So not a lot of conviction in our target price, is that?
Well, as we mentioned earlier, like things changed a lot this week. Because like what we have, our calculation was like Lacey mentioned earlier, like 2 weeks ago was like 24. And earlier this week, when the CEOs stepped down, the price actually did increase a bit. But then later on that afternoon, the news came out that he was forced out of the company and they don't have any succession plan. The prices like keep going down. So I think like the reason we don't recommend a buy is that because there's just a lot of answers that Intel has not really given to the public yet, including who's the new CEO, what's the plan with the CHIPS Act, because if the new CEOs are not aligned with that and they don't get the money, then what's gonna happen? So like buying that right now is kind of risky in my opinion. So we think like maybe holding the position and see what's gonna happen in the next few weeks. Because like the sooner they announce like the new CEO, the better for the company and what's going on with the CHIPS Act as well. So again, if you asked us the question 2 weeks ago, it would be like, yeah, this definitely a hold. But like now we also think like hold and then just wait and see.
I don't, I mean, like, I don't understand. Is the story at the end of the day that they lack the tech innovation to produce? I mean, like, here's the AI. All you do is read articles about AI all the time. And you hear that they're investing, like, OpenAI is getting billions of dollars to invest and basically buying chips upon chips upon chips. So demand is seemingly, a bottomless pit. They're one of a few providers of the tech or are closely adjacent to that tech to provide it. And yet you guys walking around like we're at a funeral and like this is the future is dead. And I just don't, there's an incongruence there. Like, is it because they're like Kodak and they're like, no, we think everybody's coming back to this kind of a chip and they refuse to move off of that? That doesn't seem like the story, but that seems to be the story you're telling, right?
Yeah.
I mean, I don't get why you're not at $20. I mean, it's been 70 or whatever. You're not more optimistic about its future, particularly given the rest of the industry. Like, do you just think that there's low barriers to entry and someone else is going to come in and eat their lunch and they're never going to innovate or they're never going to be able to buy engineers to develop new chips? Or, I mean, I feel like a company like this should be like right around the corner from a new chip and high margins for a short period of time at any given moment. And is that the case or not the case? I mean,
well, they had launched a Note, which I believe is 18A, and it has been like a lot of people speculate or like as like hoping that the chip would be a kind of innovative step for Intel. But so far, there haven't been so much like feedback or any, from what I know, again, I don't want to say a lot of things I don't know. From what I know, there haven't been really a lot of like updates on how the chips are doing or how it's performing. And like Luke mentioned earlier, I think it's just like all the company have a lot of like good innovations, and Intel's like slowly adapting into the AI industry and wasn't able to catch up with that.
Yeah, I was just gonna say that they've been really lacking, especially with their processors. I know Taiwan Semiconductors, I think they have like double the nodes on their chips, whereas like Intel's really been struggling to get to that level. So yeah, they are like, I guess, on the cusp of that new chip, but I mean, it's it's like, who's to say, like,
Is it your understanding that their chips are sold primarily to the computing businesses in like personal computers or business work computers? As opposed to the chips that are doing really well are sold into the big data centers. And so is that your understanding or is that a fair?
It's a fair assumption, yeah. Yeah, assessment. Most of their market is CPUs, is for desktops and laptops. And majority of where all this money is being made now is the data centers and the AIs and all that cloud computing and that heavy workload stuff, so.
So if that's the case, you know, coming out of COVID, businesses said work from home, there's a big demand for PCs, individual PCs. We had this big ramp up and I think you showed it in your 2021 numbers, they look pretty good. Are we just paying for some of that now with the kind of downward movement in PC demand? And there could be this next wave higher as people do refresh and perhaps at that point there is actual usage of AI on a PC as opposed to AI in the cloud, which seems to be what's available today.
Well, actually, I have that in my report, but I don't have it here, but the trend for the PC demand actually increased after COVID, but it's been it's like going down, probably going very slowly from 2022 onward. The reason behind that is probably not so many people demand PC anymore, or it just, well, like a computer can last really, like you don't need to update your computer as frequently as you used to. So the demand for PC wasn't as high as it was right before COVID or right after COVID. So that could contribute to, like partly contribute to why the trend for PC has been growing slowly.
I have one more question is, based on your presentation and your recommendation, it seems how good about future, we're not sure, but recommending a hold means it cannot go worse. Could you give me one reason it cannot go worse?
So current price is $20. Our tangible asset per share is about 18.3, and the stock did reach about 18.5 during summer. So what we think is that since it's very close to the bottom already, I mean, the worst case scenario is it's dropped into like that bottom line, and hopefully it's gonna go back up again. So I mean, like it could go worse, but the margin of going worse and going better, it's like the margin is like way bigger compared to.
Why did it go to 26 a couple of days ago?
What did it go
25
to?
26.
Well, simply because like the CEO, since he get into the office, the stock price going down like almost 60%. So when the CEO stepped down in the afternoon, I mean, I'm just saying according to the trend, I believe that people had high hope that something would happen and then the new CEO would take over and then make the company better. But later on Monday in the afternoon, news came out that he was forced. So technically, like it was not volunteer, and it turned out that Intel doesn't have any succession plan for someone to replace him. So now the company is just like in chaos of like looking for a new CEO. So I guess like that explains how the market reacted.
That is one reason, but if you look at the government behaviors, the news you missed a couple of days ago is government is giving money to Intel. Yeah. So that's a reason to drive the price up. And another argument you can use is because Intel provides chips for military use. So US government cannot let it go worse. They will give them a couple million or billions bill. If that's not enough, I expect they will do more, right? So this is not only related to like just one chip company or AI, but also related to the security of the country and the military use. And that's one reason it cannot go worse. I totally agree with because of that. That's mine.
But just in case, what's the book value per share?
Well, technically we use it as like a floor value, which is like if the company sells up all its assets, that's how low the price it can pay to the investor or like the stockholder.
Yeah, I'm curious what that number is.
18.
18?
Sorry.
It's 18.3. And we have it's the first phase appendix.
Welcome everyone to the Boeing Group. It's the grand finale with the fireworks of the night. I'm Evan Engel.
I'm Jake Hendricks.
I'm Will Trout.
I'm Gunnar Gorgon.
Aaron Lagios.
All right, so we jump into it. Just a little overview, starting with a little business analysis, jumping into some revenue breakdowns. Look at the competitors a little bit, touch on the supply chain issues they've been facing. Also look at the debt and equity, followed by financial ratios. Come to the two key drivers we believe is going to drive the company into the future. Look at our target rate, our EPS, our recommendation on where we're going to be going with the stock in the fund, followed by our final summary snapshot. So Boeing is a recovering stock. They've been profitable. They have a lot of money in the past, but since 2020, they've been facing a lot of difficulties with getting past that curve of the manufacturing and operating issues they had in 2020. We believe that they can be profitable in the long term, but as of short term, they're looking very bleak in their outlook, as they have been the last couple of years. They're also facing a lot of issues becoming profitable due to legal concerns and backlog issues. So our group has been exploring the recommendations of a stop loss order on the stock. Boeing's negative revenues and long-term struggles in completing their 737 MAX, which is their primary product, has been a major issue the last almost half decade. So management turnover, they have a new CEO coming in this year. Calhoun is finishing out the year, but they have new management and almost an entire new executive staff jumping in as of 2025. Boeing's looking to solve a lot of their changes in leadership. It's going to help their changing culture as they drive the company forward. And we believe that's another key driver that'll help them a lot.
So as Evan mentioned, we're looking at a stop loss order withholding the 12 shares that we currently have of Boeing. We're looking to put that stop loss at roughly $137 per share. Right now, the current price is about $154 a share as of noon today. And our target price is $148 a share with a target return of negative 3.36. Boeing currently operates within 3 segments, first being commercial airplanes, second global services, and then space and defense security. Boeing has a lot of challenges with regulation and competition with Airbus specifically. However, there are opportunities for them to gain some market share with a jump in sustainable aviation. Our key drivers that we went with for Boeing are their commercial airplanes and global services. But Boeing also does have some main risks, being geopolitical instability as their suppliers operate in many different countries, and their dependency on military contracts. So a little price history. Boeing hit a 52-week high of about $267 a share. This occurred late December last year. And their 52-week low was just 3 weeks ago at $137 a share. So you can see how much they've jumped from that in the 3 weeks since, at roughly 15% over that 3 week span. The year-to-date return is negative 39%. And currently within the Spellman fund, Boeing only has 12 shares valued at $1,896, which was once valued at $5,160 in 2019.
So just looking at revenue streams. So Boeing has their revenue streams broken into 3 main sectors, as mentioned: commercial aircrafts, global services, and defense, space, and security. Commercial aircrafts makes up the biggest margin of this, defense second, and global services third. And then if you look at the graph from 2020, you can see that both commercial aircrafts and global services have kind of steadily increased since that COVID year. They haven't quite reached the 2018 years that we'd like to see them back to, but that steady increase is why we see them as the main 2 key drivers. And then for the 5-year growth rates, commercial aircraft's average has been negative 2.48. They had 2 really bad years in 2019 and 2020, as that's kind of expected, and with COVID. Defense, space, and security's average was 1.84, and global services was the highest at 2.86. And then just looking more recently at the last 2 years, revenue streams across all 3 major platforms have increased from 2022 to 2023, which is a huge look into the future for Boeing, as in previous years it has dipped well below where they used to be. Especially with the new CEO taking over, we see potential upside for Boeing. ESG isn't really a strong suit for Boeing, I'd say.
They are promised to have net zero emissions by 2050. Also, along with Airbus, their competitor has that same promise. They do have transparency within their reporting, and they do have a high community impact. However, their main cons come with historical environmental concerns with that high carbon footprint that they deliver, as well as outstanding lawsuits and societal challenges such as that labor strike that they were just dealing with not too long ago. Product design, life cycle, and supply chain management is where they struggle as well. So overall, we rate Boeing neutrally unfavorable in their ESG rating.
So we have a number of risks for Boeing that we have analyzed and put into our report. Just to look at some of them, when it comes to very negligible or low-level risks, finding new investors, it seems like there's always people that want to throw their money at Boeing. A lot of people deem them too big to fail. Some people have been a little too optimistic with them in the future, some people in this room. But, you know, it's a stock that's went through a lot in the last half decade. So long-term debt payoff, they have a lot of debt issued through 2028, but they faced a lot of legal discrepancies, which have been a large problem for them, as well as they got doors falling off of planes. And then their short-term earnings, they're looking to be very negative in this upcoming quarter. It drops a lot. So for medium risks, the changes in leadership, they have a new CEO that comes in this next year. He's coming from a background in aerospace engineering. He worked with a company that previously Raytheon, now RTX, which is a very defense-headed sector. They're a subsidiary in aerospace engineering. So they think he was a great fit for the job. Kavun was removed and he steps down and Orberg takes over in January. So there's also a couple changes to other management positions in the board. But we believe that his changing company culture will help the ESG as well as the profitability of the company long term. Other moderate risks, they're losing defense contracts to competitors. A lot of competitors are looking to encroach on that area as they emphasize in commercial aircrafts and their growth services. Lockheed Martin and Airbus are two of those major companies that have higher growth rates right now. As well as another high risk is manufacturing difficulties. They faced a 7-week strike where they're losing about $100 million a day almost through those 7 weeks. They recently came to a stalemate and they were able to come to a solution with the union, the workers' union. However, there's still disputes over the wages of a lot of the people who work for Boeing. So people are getting laid off left and right, which can also lead to major issues in the future.
For our financials, we don't have past PE or PEG. This is because of the negative EPS. For the ratios that we do have, you can see that they have not been performing well, especially compared to some of their competitors like BAE Systems and Airbus. It's also important to note that to calculate, for return on equity and debt to equity, those numbers were altered to calculate shareholders' equity. We had to add back treasury stock and other reserves.
Looking at the debt structure, so Boeing's debt is currently at $57 billion. Its free cash flow for the period is negative about $2 billion. They have significant losses and they had to deal with their problems in 2020 with manufacturing and shortage of workers by reaching in and establishing a lot of long-term debt through 2028, most of some notes and bonds. So they're losing money hand over fist, but this debt should help them in the long term. Most of it, they have some issue this year in 2024, but it's not a very large amount.
So just looking at our baseline valuations broken down into sectors. For commercial aircrafts, we used a constant growth rate of 6%. For global services, we used a constant growth rate of 4%. And for defense, space, and securities, we used a constant growth rate of 3%. One thing to note on this page is the big jump in EPS from 2024 to 2025 for both those sectors. With the labor strikes, the profit margins kind of expected to stalemate. But from 2022 to 2023 for commercial aircrafts, the profit margin grew 5%. In the right direction for defense, space, and security grew 8%. So we used those profit margins from 2024 to 2025, which kind of resulted in those big jumps.
So Boeing's number one opportunity for growth is going to be their commercial aircraft sector. There's a few reasons for that. First is the recovery in air travel demand. And according to the International Air Transport Association, We're supposed to be back to where we were pre-pandemic in terms of total passengers. You can see the growth rates for total passengers there, and you can see it's especially big in the Asia Pacific region. So we believe that region can be a region of growth for us. And then also airlines are continuing to modernize their fleets. A lot of them made commitments to sustainability efforts, so they need more fuel efficient planes like the 737 MAX. And then also Boeing has a strong order backlog, so that ensures the demand is there. It's more just can Boeing get out there and deliver these planes. And then here's a slide showing the deliveries they are able to make. You can see 2018 and prior, the deliveries were looking good, and they've been trying to get back to that, and they dipped down in COVID and slowly climbed. Last year, they also had a slight dip. That's mainly due to the labor strike. So we do expect a stronger bounce back in 2025. And then you can see 2026 and 2027, I just applied a 8% growth rate, and that was the average of the 10 years before COVID, the growth rate of plane deliveries. Next slide. So with that being said, we landed on a projected annual revenue growth rate of 6%, a little lower than the 8%, which is the average growth rate of the deliveries. That's mainly due to the kind of the volatility you can see over the past 8 or 10 years. It's been very back and forth. 1 year is positive, then it's negative. So we want to be a little more conservative with the growth rate, and then also the profit margin. They've been negative the past 5 years, so we're hoping 2024 they'll also be negative, and then we do project in 2025 they'll be closer to zero. And then in the bottom here you can see kind of what that 6% growth rate would look like over until 2028.
So for our pessimistic and optimistic scenarios, we used a 3% for our pessimistic, just taking our optimistic minus our expected. And then for optimistic, we used a 9% growth rate, which is actually close to 8.16 that Aaron was just mentioning. But to come up with this number, we took the last 4 years' growth rates divided by 4.
And this is what it would take for Boeing to get back to their 2018 numbers. It would be a pretty lofty goal, as revenues in 2018 were over 60 billion. And with our optimistic scenario, it only got us to 47 billion in 2028. So in order to get to 2020 or 2018 numbers, it would require a 16% annual growth rate, which is pretty lofty. So we don't see them getting there by 2028, but we do see them steadily climbing there, maybe by 2030, 2035-ish.
Our second driver is global services. Global services makes up around 25% of total revenue for Boeing. It's been a recent bright spot for the company, delivering very strong results. They have had strong operating margins for the first 3 quarters of this year, which matches record levels from 2023. We think this sector set up really well for the future. This past quarter, they just secured agreements with Landing Gear Exchange Program and integrated a material management with Allen Pound Airways and a KC-135 spares contract from the US Air Force. We use a projected revenue growth rate of 4%. We got this by averaging the previous 6 years' growth. And then below, you can see the revenue projection with that 4% growth rate. For a pessimistic scenario, we use a growth rate of 2%. This is calculated by multiplying the expected growth rate by 0.5. The only negative growth in the last 6 years was in 2020, but besides that, they've had stable growth on the positive side. So the 2% is kind of a worst case scenario for this sector. And then for our optimistic scenario, we use a growth rate of 9%. This is calculated by averaging the growth rate from this sector for the previous 6 years, excluding 2020. And they've had a positive operating income each of the last 6 years. So this just shows that they're good at managing their costs and increasing the revenue.
And then just for the last sector is not really one of the drivers for us, but for defense, space, and security, we used a 2% growth rate for pessimistic, taking the optimistic again minus the expected. And then for the optimistic scenario, we used a 5% growth rate. For this, we took the previous 2 years before COVID-19 plus the last 2 years divided by 4. The 2 years kind of during COVID, the average growth rate was around 1%, so we just didn't really include that.
And this table is the sum of all of our sector projections added up into one table. For 2024, they're the same. With little time left in 2024, we didn't want to project pessimistic and optimistic. So using the same revenue amount for each resulted in the same EPS.
Then on this slide, the main factor we gotta look at is the 20% weight for the PE method and the 80% towards discounted cash flows. This came out to a baseline projection of the $148 a share. Pessimistic came out to $142 a share, while optimistic came up at $166 a share. Compared to that current price, which is around 154 rather than 158.
So portfolio fits, the industrial sector is an area in the Spellman fund that is, I mean, we don't have a lot of stocks in. We know that there's another team that's pitching Trane, that might be another possible stock that you could add to even the amount or the percentage that is split between industrial stocks, so we could meet that level that's equal to the S&P at 10.35% of the fund. We're currently at 7.5%. As when it comes to Boeing, we only make up 0.33% of this entire fund. It's such a small amount and it's at a low. We just thought that'd be a better method moving forward to keep this hold at a stop loss, because selling low off of the stock just doesn't sound like the right idea. The positive return in the long term, we believe will be beneficial, but it is at a negative 46 year to date return. So. Yeah.
Then just a quick snapshot of what we covered. They have relatively high debt levels, 53 billion in long-term debt as of June 2024. Boeing did suspend their dividends back in 2020 until further notice. But then with the new CEO, we expect them to make some major changes as they attempt to come back, focusing on culture change, cutting costs, and getting those deliveries out. So we are recommending a hold with a stop loss order. And our target price is $148.83. They're optimistic about 170 or 166 and pessimistic at 142. That's all we have for you.
Question now.
Deliveries. Do we make up that number, or was there some guidance from management as to what we
So-
expect from 25 and 26?
We're estimating through what we've seen through the delivery amounts, the biggest drop this year will be Southwest Airlines. We're looking probably 50 to 60 planes short of their target, which is I think 450 planes for the year. And we don't know exactly how many planes they're gonna be able to get out by the end of, I think their earnings are in January 31st. But we project that they're not gonna reach the benchmark they need to.
In 20, so go back to slide 18. Did they close a facility since 2018 or reduce workforce since 2018?
I'm not sure about facilities or not. I think the main dip is just they had so many other issues during COVID. Like they weren't able to manufacture planes either. With the supply chain issues, I think was the main reason for it. And they were able to kind of slowly start recovering until the labor strike, and we're hoping they can avoid any major issues going forward to continue growth.
Because if they didn't close any manufacturing facilities, there hasn't been a significant reduction in their workforce. If they clear all those hurdles, it shouldn't take that long to ramp back up since the capacity is there. So when the question was, what is it going to take to get back to those levels? Well, if we cleared all the regulatory issues with the Air Max and can go back to full production, we don't have any more doors flying off. It shouldn't be an unreasonable target. Just
Yeah, I think
this seems conservative to me based on what we saw from 2014 to 2018.
Yeah, you might be right. I think in 2025, we're pretty conservative of only getting back to 502, just with the labor strike. So I think we probably could have projected that a little higher and then growth from there.
I think we are being a little skeptical because although the union did come to like a close on the wages, which was the major issue with a lot of the workers with Boeing, they did they laid off a lot of workers to do this, and that problem with the workforce is also why we think maybe going forward we're a little skeptical on how much they're gonna grow in the next year.
So we're thinking max capacity may not get back to those levels.
Not in the next year. We're gonna see, we've been looking at the growth rates because we know that those projected from FactSet and Value Line, we're looking at about 16% drop and EPS and the growth rate compared to competitors. I believe Airbus is at 6%. You have Lockheed at about 8%, and this year we're projected about negative 12%. So, but going forward, if you jump to 2025 and the resources that we used, you're looking at about we jump up to almost 20% in growth rate in 2025, while the others actually decrease in growth rate because of our contracts. We have such a strong backlog. We believe that they will be profitable in the long term, but we're just nervous in the short term. So that's why we did the stop loss.
So your profit forecast, did that include the new wage structure that was renegotiated?
As they continue to negotiate these wage structures, it happened about 3 weeks ago in the middle of our project, so I wouldn't say that we calculated it until
Do you have an idea of what that new wage structure looks like?
No.
Yeah, and I'm thinking of the leverage in this company and the new expense that's coming on. And what we're kind of counting on some growth rate, but if the margin shrinks to near zero, because of you've got two competing factors there, there may be growth, but the profitability of this company, I need a better understanding.
Explain your thought process around the stop loss order.
I guess currently with the stock at about, with being so volatile within the last 3 weeks, and it was at 137 3 weeks ago, and now it's all the way up at 154. We thought that stop loss was set there. We don't see them going below that line unless something drastic changes within the next couple weeks. You know, with Boeing, there might be new articles, new news coming out every other week or so. So we think that if something big does happen, then the price will fall below that low of the last 52 weeks, and then it might be a good time to get out as of new news coming out.
You feel like if something big, obviously unpredictable, but that would be materially enough to say the long-term projections are no longer valid.
Yeah, I guess then if it does fall below that, we are suggesting that another group does reevaluate Boeing within the next couple of years, just because all the things that have happened to them recently with their supply chain and the struggles that they've had.
We know a group did look at Boeing about 2023. I believe there was a group that reevaluated Boeing, and they were very optimistic about the future of the stock. They had them producing almost 500 planes, which is about 150 more almost than what we had them reaching this year. So the optimism around Boeing, we can see where people may believe that it can be profitable earlier, but we think the profitability and the positive revenue streams will come further down the line.
I just see it as, you need planes, and there's very few suppliers of those, and each supplier has limited capacity. So it's hard to imagine the company going away. And so from a portfolio management standpoint, I feel a little hesitant on putting a stop loss in because market prices can do anything. You can have technical error on the exchange and you get the price to fall, and all of a sudden you sold and nothing changes fundamentally. So I just wanted to understand why you guys thought it was an appropriate reason, or if you had some risks or concerns that you would want to sell if we did see a drop in price.
Yeah, that was our understanding. When it comes to revenues, when they do have these orders that are late and they cannot reach these quotas, what they have to do, they also do have to pay and give, I believe, credits to a lot of these companies like Southwest that are facing these shortage of planes, because a lot of these discrepancies have been creating issues in the commercial air market. There's a lot of people that need planes and they're not getting them, and they have planes that they have that pieces are falling off them.
Mm-hmm.
So really, it has been just negative where we just see so many negative factors going into their future that we just thought it might be important to have some type of safety net.
Go back 2 slides.
This way or the other way?
20, or I'm sorry, to 16. So constant growth rates on the far right, is that post 2028 and beyond? I'm assuming.
Like, would we keep that for?
The difference between 493 and 450 is 43 cents. That's more like 10% year on year versus 4%. The move from negative 253 to positive 321. I can't even do the math on that, but I know it's more than 3%.
Yeah, that also takes into effect with the profit margins. After 2025, where I mentioned we had like the big jump, we have more of a like volatile, a little bit of profit margins between like 1 point. Or are you saying for global services?
So are you saying this is the revenue growth rate?
Yeah, so that 6, 4, and 3 is the revenue growth rate, and then those are the EPS.
Not earnings per share. Okay. Thank you. Future reference.
Yep, yeah.
I would either label it if it's something different, because your average schmuck is gonna look at this and go, right here, that's not 6%. That's not 6%, and you're showing me a time series, and you kind of assume that rate is there. So differentiate between those two. Constant growth of revenues, this is what that translates to in earnings per share. And I have one more math exercise for you on slide 8. There's another group that kind of did the same thing. So those numbers, average of minus 2.48, is that a simple average? So you just take 46.9 plus 49.9 plus 20 point that? Yep. Okay. If something goes up 10% this year and down 10% next year, what's your average over that 2-year period? Be 0. No, it's more like minus 0.5. Up 10 takes you to 110. Down 11 goes to 99. So even though you went up 10, down 10, doesn't mean you average 0. There's a slight negative tilt to it. So that's, as you're looking at those numbers, you might find when you actually sequentially start at one point and get to the end of it, it doesn't necessarily line up with that average. And in fact, you have a multiplier effect when you have large swings, which you find out when you do leveraged investments tied to gold prices and they go up 10%, down 10%. You don't break even, you lose more. Trust me.
Tyler, when your orders is private checks, you guys delivered so that we can fly private up here next semester. Thank you, Tyler. Well, when do these guys actually get paid on their deliverables? Like, do they get paid? What's the payment schedule? And where I'm going with this is I'm wondering what their free cash flow situation looks like. You know, because they're putting all this time, into this product that's obviously very expensive.
Yeah.
And you're delaying deliveries. So when do you guys know when they actually get paid on the planes?
When they get paid on the planes, I don't think I can tell you exactly. But when I look at how we evaluated it with 20% PE and 80% discounted cash flow.
Yeah, that was another question I wanted to know. You're one of the few groups that I've seen almost flip that ratio, but most people use PE versus free cash.
So when you look at, when we're using PE and we're looking in the short term, we see how negative they've been. We just see that there's so much, and all the value of Boeing is really in their backlogs and all of their contracts that they have. So having this, it's almost like having internal, long-term, way to say this.
Take your time.
In the long term, we believe that they can discount through their future profitability and how much they're going to be making through these backlogs. That the backlogs is a strength. They have about 6,000 planes that are waiting in this supply chain to be released. So wherever they need somewhere. Yep, somewhere. And these planes, there's 6,000 of them, which it's strong to have that many contracts. But at the same time, they're reaching a point where they have too many contracts, too little employees, and there's been so many issues with legal discrepancies they're facing. They have large interest expense. They have a lot more other issues with legal posing with legal discrepancies they're facing. Yeah, and they have to pay. We're premiums when they don't get their planes out on time. There's so many negatives with pricing that is becoming an issue with the future. They have a lot of money, but the future profitability, we just think it's gonna be a problem. So that's why we're worried.
And did they have to issue a bunch of shares too recently? You know,
Off the top of my head.
one of these dumpster fires did. I can't remember if it's these guys or somebody else.
Well, what was your share count? How many shares outstanding?
Shares, we used like 640.8 million, I believe.
I was thinking more like 747. 747.
The dumpster fire, but there's a lot of money in the dumpster fire.
There you go. You listened to your problem last Monday. Just a quick note on that. So, the tone that you guys had compared to a different dumpster fire presentation that we listened to was much more sobering, and it was even keel, which when you're gonna have situations like this later in life where things aren't going well and you have to present these, that's your best bet, is to have that kind of even keel presentation, because if you get too down, everyone in the crowd gets pessimistic, and then it just feeds on itself. But if you're up here and you're blowing smoke up his rear, we also know that as well. So I want to commend you on, these are the facts, these are what they are, here's how it is, but try to keep that, presentation style, which I thought you guys did a better job than maybe some others that kind of, what was me type thing. That's not good either, so.
If they're losing $16 a share, how much cash are they burning through annually? And do they have adequate cash where they will or won't need to issue debt or issue more shares in the next 2 years? What was our look there? And I know you did the work because I asked you to do it. Or did you?
We have all of this on our report. The report is huge if you guys want to read it. How long?
You can bring it to the cocktail hour.
Sure. When it comes to, I don't know about the shares, but when it comes to issuing debt, I know they're becoming leadership changes. They had no intention of issuing any shares. I don't want to blow smoke or this.
But I think you're right. So I think what we were talking about was at a $2 a loss, $2 per share loss, which is what we're projecting for next year. You still end up cash flow positive when you take out those non-cash goods.
They've been cash flow positive, which is surprising considering how much, but at the same time, there's been so volatile in the last 4 weeks alone. When we were on value line, I believe during our scenario analysis, we were expected to be at -2. I think that was three weeks ago, and now we're at 16. So the growth rate is changing a lot. The more that these plane contracts are being canceled, which they have been week by week, it's not like it's all at once, but each week you see more and more of them complete. Investors become more scared. And, the price gets scared.
So the backlog was 4 million planes? Or I'm sorry, 6,000 planes. They can deliver 500 a year.
And they also have a maximum amount that they're able to buy. I forget the aviation committee, but they're only allowed to create a certain amount of each type of plane to release each year. So, and they haven't been reaching that quota. And at the same time, this year, they may have been able to actually meet the amount of contracts they had for this year. They're trying to make up so much and tread water for that 2023, 2022. We've been getting those orders, so they